So let's start this session without any delay. So first of all, let's talk about financial statements. See, every organization like Reliance, Tata, yes, Birla, Ambani's, all they are running their companies. But if they want to know about their profitability, if they want to know about their profitability, about their position, about their expenses, about their losses, yes, their expenses, etc., etc. So, how they are going to check it? Every time they are not going to open their journal book, they are not going to open their ledgers. Even if this type of companies, if they want loans, so can you tell me which is the document, um, as a banker you are going to ask? Of course, income tax statement. Yes, you will ask about balance sheet. Why you are asking balance sheet and profit and loss account? Because this gives the clear idea about this companies, whether they are earning profit or whether they are in a loss. So with this statements you are checking their profitability or they are into a loss, correct? So already we have understood how to prepare this with the help of journal, ledgers and trial balance. But every time if they are preparing their accounts, they need to follow some standards. Like in banks, you are following that for reporting purpose to RBI, for reporting purpose to income tax. Yes, for reporting purpose, we require some standard formats. Correct? So for that, we have company accounts 2013. As per that, they have already given under this financial statements about these five important things, that as a company you are going to pass journal, ledger, but at the time of reporting, at the time of closing of your financial year, you need to prepare this financial statements. And if as a company you want loans, if you want any subsidy, or if you want to apply for any tenders, you require this statements. So financial statements includes five things. Number one, that is your balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and explanatory note. See, balance sheet talks about position. Yes, about financial position. And especially we prepare balance sheet for any particular date. Yes, not for whole financial year we are preparing. No, for any particular date you are going to prepare this. And generally we prepare balance sheet on 31st March. Yes, then next is your profit and loss account. Through this you can know about the profit or loss whatever earned by the company, and this is prepared for 12 months. That during the period, uh, what are your expenses, what are your incomes, based on that you calculate profit and loss account. Then cash flow statement. Now cash flow means what? See, this is a very neutral term, cash flow. Why this is a neutral term? Because suppose here is your Reliance Industries. Reliance Industries, they are selling the product, and for selling the product they require purchasing of raw material. So if they are selling the product, customers are paying the cash. Yes, yes or no? So this will lead to, for this organization, inflow. But in case of purchasing from suppliers, they need to pay. So this time when they are paying to the suppliers, this will lead to outflow. Correct? So cash flow includes both the things, inflows and outflows. So this will include both the things. So we have one particular unit in which we talk about cash flows. So generally in that we are talking about only and only when there is actual cash flow. No credit transactions we are recording. No credit transactions. Only when real cash flow is there, then only we are going to talk about it. The next is your statement of changes in equity. So, as an investor, when you are investing in any companies, so during the financial year, companies are maintaining this data, opening shareholders, if any new shares during the year they have introduced, or if they have done any buyback. So, all these things they are recording in this statement. And finally, they are closing this. So, this is financial statement. Under that, this is the fourth thing that companies are preparing. But not every company is preparing. Okay, only if that is applicable for you, then only you need to prepare it. And this is statement of changes in equity. Last one, that is explanatory note. Now this is very important. Now explanatory note talks about whatever you have mentioned in your balance sheet. Suppose in balance sheet you are showing loan. Yes, only loan, and that amount you are going to show, suppose 10 crores. Only this is you are showing. But if you want to give any extra information, if as in company you want to give any extra information related to that loan, or suppose in future someone means currently someone filed uh, case, yes, court case on you. Currently someone filed court case on you, and because of court case you might see in future some liability. So you need to mention these things in your financial statement, and how you can give this disclosures through this notes. Correct? So this is just a extra space for clearing your points, because as a company you need to disclose, you need to be transparent. Correct? So these are the five different financial points under the financial statements. Again, I'm repeating: balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and explanatory notes. See, let me tell you one more thing related to this only. We have one term that is final accounts. So till previous units, you must have seen preparation of final accounts. Yes. So what is this? Again, this talks about your balance sheet and just profit and loss account. Only these two things. But when we talk about financial statements, this includes five things: balance sheet, profit and loss account, then your state changes in your cash flow, then statement of changes in equity, and finally notes. So these are the five different things you need to maintain under financial statements. So that is the only difference between final accounts and financial statement. Now I hope you can remember this, because this is very important from the exam point of view. Then, though we have already seen that financial statements we need to prepare, five different accounts we need to prepare, and we need to follow Companies Act 2013. Correct? But we require format. What Reliance company, what Tata company, what this uh, Birla company, or any type of company, whatever they are, you know, preparing for balance sheet, they require some format. Yes, and how they can get that format? Through this schedule 3. That's why whenever you are taking documents for loan purposes, you might observe that overall the format is similar. Yes, like A company's format is going to be similar with B companies, C companies, because things are standardized. Otherwise, we have different managers, we have different finance department, so they will prepare according to them, and this will lead to confusion. So to avoid the confusion, Companies Act 2013 already prescribed you the format. Under which schedule? Schedule 3, which talks about balance sheet and profit and loss format, like how to prepare it, so that at least basic standard format you all must have. Like say in banks, when as a customer, if I visit and if I want suppose account opening form, so already you have a standard format. Yes, you will provide me that document. Or if I want to withdraw some amount from bank, so again you will tell me that ma'am, there is, yeah, that withdrawal form, please fill that form. Correct? If I want to start any saving, again you will tell me, ma'am, this is the form, please fill this form. Why? Because you want things to be standardized. See, if there are 1,000 customers, they are visiting in just a single day, and if each and everyone they are writing by their own, and everyone wants to open their account in that particular bank, but things are going to be different. Yes. So to make it standardized, like in your banks, same in accounts, while we are preparing, we have some standards. For that, we need to follow Schedule 3. But remember, when we talk about like this banking companies, insurance, or any company engaged in generation or supply of electricity or any other class of company, if they are required to follow any special act, like for banking companies, we have Banking Regulation Act. Yes. So, first of all, you need to follow that Banking Regulation Act. For insurance, we have their own act, IRDA Act. So, first, follow that specific act. If in that specific act anything is pre- prescribed for this preparation, then you need to follow first that act. If nothing mentioned, then you can take the help of Companies Act. Companies Act is a very wider, you can say, you know, area covers. But if something is very specific for any specific sector, then you need to follow that specific act first. And which are the companies which have their own specific act? Like A, banking company, B, insurance company, C, company engaged in generation or supply of electricity. Or if any other class of companies, if any specially mentioned or specified to you. Yes, so this is about financial statements. Now, coming to the next one, financial year. You all know about this. Yes. So, when you are closing your books on 31st day of March, not only your bank, every businessman, everyone is closing on 31st day of March, and you are starting 1st April. This is your opening. Yes, this is a new financial year, and 31st March, this is closing. Correct? So everyone knows about this. Everyone knows about this. In India, we are closing our books on 31st March. This is a very common point. Everyone knows it. But the important point here is this, B1. Now, you know, in our previous unit, we have seen about registration. Correct? If you want to start your company, you need to take registration under Companies Act 2013. Yes or no? So when you are registering your company, or you can say when you are starting, if I say in a very simple word, if you're starting your company, hmm, so if you're starting before before 31st December, and then you have after 31st December. These are the two timelines that you need to see here. If you are starting your company, you are getting registration before 31st December. Yes, suppose this is your December 31st December 24. In case you are registering during this time period, means from 1st April 24 till 31st December 24. If you're registering within this time period, you are going to end your financial year on 31st March 25. Yes, this is the point. Now, next is if you're registering after 31st December, means you are registering 1st January. I'm taking the same 31st December 24. If you're registering from 1st January, yes, you are registering from 1st January 25 till 31st March 25. If during this three periods if you are registering, so your end of that financial year is not going to be 31st March 25. You are not going to close your books on this date, 31st March 25. You are going to close your book on 31st March 26. This is the point given in your B, and this is very important. Yes, and remember, in case where company or body corporate is a holding company or a subsidiary of a company incorporated outside India, you are required to follow different financial year. Generally in India we follow 1st April to 31st March. But if you want to follow 1st January till 31st December means calendar year, then you need to take the permission. What you need to take? You need to take permission. And who will allow this? Tribunal. Who will allow this? Tribunal. And that is your financial year. Correct? Every year you need to close on 31st March. That is very basic point. Important point is if you are registering on or after 31st uh, December means 1st January or after 1st January, your ending of that financial year is going to be following year, not that same year. Correct? So this is about the financial year. But now if you want to follow any different year, time period, any different financial year, then you need to take the permission from tribunal. So these are the three important points under financial year. Now, let me tell you about form of balance sheet. So this is the schedule 3 which prescribes the form of balance sheet. So part 1 talks about the balance sheet, part 2 talks about your profit and loss account. You need to write the name of the company, balance sheet as at like which particular day you are preparing. Like suppose you are preparing for 31st March 2025. Okay. And you are suppose Reliance company, and as per that you are following. So you need to start with first liability side. See, these type of format is known as vertical format. Yes, this is a vertical format. So you have one particular side, then you have notes, note number. If you want to give any detail, so you can use this note number, and for the reference you need to check then explanatory notes, that fifth point from your financial statement. Then you are going to use two types of more columns, like first figure at the end of current reporting year, that is 25. Yes, so whatever happened from 1st April 24 till 31st March 25, you're going to record it here. And the next column, that is your previous reporting period column, means your 1st April 23 to 31st March 24. Basically here you are creating comparison. Yes, comparison. Okay, so this is your current year, this is your previous reporting period. So you start with the liability side, equity and liabilities. So different types of share holders we have, so all about that we need to write it here, like your nominal share, then issued share, paid up capital, yes, forfeiture, everything. You need to write it here. Reserves and surplus like your general reserves, capital reserve. Yes, all these things you need to record it here. Then share application and pending allotment, if there is, you need to record it here. Then non-current liabilities. Whenever you see non-current liabilities means the liability is going to be more than 12 months. If the time period is more than 12 months, that is going to be non-current liabilities like long-term borrowings, like you have taken house loan. Yes, that home loan you have taken or vehicle loan you have taken. So you need to record it here. Then deferred tax liability, other long-term liabilities and long-term provisions. Then current liabilities, if the time period of the liability, that obligation is less than 12 months, you need to record it here. Like if you have taken for 6 month debt or 2 days borrowing, whatever that can be. So if that is less than 12 months, you are going to record in this current liabilities. And finally, you can see here you need to total it. And always remember your total of liabilities plus capital is going to be equal to what? Assets. Already you have seen this, yes, in your balance sheet equation. So the basic, this equation we are following in each and every time, yes, whenever you are going to talk about balance sheet. Now next, assets. What next we need to talk about? That is about assets. Assets means you have some control plus ownership. Yes. So first, non-current assets. Again, same. If your assets life is more than 12 months, like you have purchased tangible assets, that is your machine, building, plant, factory, etc. etc. So if you're going to use for more than 12 months, you're going to record it here. Intangible assets like your patent, yes, copyright, all these things. Capital work in progress means their work is going on, like you are doing research and development expenses. So you need to write it here. Same goes for your intangible assets. Then non-current investments like you have purchased gold, yes, silver, or you have invested in other companies. So suppose if you are preparing this statement, this balance sheet for Reliance Industries. Yes, you are preparing this for Reliance Industries. So now if you are investing in other companies like Tata, then that is your asset. Yes, you have purchased shares of Tata, then you need to record it here. Deferred tax asset, long-term loans and advances, and non-other assets. Next column is going to be, next part is going to be your current assets. Now, current assets meaning is life is less than 12 months. Correct? If life is less than 12 months, then record it here like your current investments, inventories, trade receivables, cash and cash equivalents, short-term loans, advances, and other current assets. And again, you will add both the sides, that is your non-current and current asset. And you can say this is your total amount. Yes. Now, this total amount of your assets needs to be, um, tally with this liabilities and capital amount. So this is about the form of balance sheet. And remember, this is very important from the exam point of view. So we have covered all the important things.
So first of all, we need to understand what is this cash flow, because without understanding this, you cannot adjust the transactions. Yes. So let's start with the first thing, that is cash flow. Okay. So if I talk about any organization, yes, suppose this is your Reliance Industry. Now in Reliance Industry, we know they are going to sell, yes, whatever they are manufacturing, whatever services they are providing, they are going to sell to their customers. And here is your customer. So now in return, customer will pay. Yes, customer will pay in cash. Yes. So what is this flow known as? This flow is known as inflow. Yes. There is a flow of cash from customer to Reliance Industries. Now, if I take one more example, this is again Reliance Industry. Now, for manufacturing, correct? For manufacturing, this Reliance Industries must be purchasing from different suppliers. What they are purchasing? Raw materials. Yes, and if you are purchasing raw materials, Reliance Industry needs to make payment. And when they are making payment, there is again going to be cash flow. Yes, without paying, no one is going to transfer you any products, whether that is your raw materials or whether there is your customers. So there is a very important, you can say, factor through which your transaction completes. That is your cash. Yes, every transaction denotes your monetary value, and in that there are two ways of your cash flow. One, if you are paying, that is outflow. One, when you are getting, that is inflow. So as soon as you are receiving your salary in your account, that is what? That is inflow for you or outflow for you? Of course, inflow for you. Yes, when you purchase any goods, suppose TV, furniture, vehicle, that is what? That is cash inflow for you, or you are paying to someone, so that is cash outflow for you. Of course, that is cash outflow. And that is the meaning of cash flow. Again, I am repeating. So whenever you are receiving cash, that is cash inflow. Whenever you are paying cash, means cash is going outside, that is going to be cash outflow. Same, this concept works in organization, like your Reliance, yes, Tata Group, this every type of companies, like in your bank also, this cash flow is there. So this is the meaning. Now let's read the theory part. So cash flow is the movement of money into or out of a company over a certain period of time. And generally, when we talk about time, you already know now that when we talk about this period of time, we are following financial year. Yes, we are following financial year. Financial year, already you have covered in your company's account 1. So in that, you need to prepare your book from 1st April to 31st March every year. Correct? So period of time generally is our financial year, which starts from 1st April and ends on 31st March. So this period, whatever cash inflow is there, whatever cash outflow is there, we are going to record. What we are going to do, we are going to record it. Yes. So if the company's inflows of a cash exceeds its outflow, its net cash flow is positive. Means what? Whatever inflow, means suppose you have received during the year 5 lakhs. Yes, from sale you have received rupees 5 lakhs, and during the year, suppose you have made expenses of around 4,50,000. Rent payment, electricity payment, yes. So all this expenses, if you combine it, that is around 4,50,000. So this is your outflow. So if you subtract this 5 lakh minus 4 lakh, this will give you 50,000. And this 50,000 is going to be your net cash, which flow? Inflow or outflow? Inflow. Okay. So this is about your cash flow. Now, when we talk about any business, we are dividing this cash flow into 3 different activities. Number 1, A, that is operating activities, B, investing activities, and C, financing activities. Yes, we have 3 types of activities: operating, investing, financing. Now, how to classify that this cash flow is your operating, or this cash flow or transaction is your investing, or this cash flow or that transaction is your financing? So one by one we are going to talk about it. So let's start with the first one, that is your operating activities. Now, suppose if I'm starting furniture business. So can you tell me what is my core business? What is my core business here? If I'm starting furniture business, so what is my main objective of this business? To purchase mobile phone? To sell vehicle? No. What is my core business? Purchasing, selling of this furniture. Yes. Okay, so this is your example 1. Now, example 2. If I am manufacturing this time cars, so tell me, what is my core business? My core business is purchasing and selling of land, purchasing, selling of computers. What is my core business here? Purchasing, selling of what I can say here, let's say pen or stationery items. Or my main business, my core business is going to be selling and purchasing of these cars. Of course, है So you can see here, whatever business you are starting, you have some main business, you have some core business on which you are going to do your daily transactions. Yes. So when we are talking about this operating activities, means we are talking about your daily activities. And if you see these 2 examples, your daily activity is what? Purchasing and selling of furniture, purchasing and selling of cars. So that is going to be my operating activities. Means for daily business, whatever expenditures, incomes I am incurring, that will lead to operating activities. So basically you can say for running your business, whatever expenditure or whatever income you are generating from sale, from purchase, that will lead to operating activities. So this particular activity is what? Principal revenue producing activities. Yes, this is what principal revenue producing activities of an entity. Now, operating activities, this consists of inflows. Again, see, cash flow when you are reading, cash flow includes your both the flows. Inflows, outflows, both the flows. Yes. So when we talk about operating activities, that will include inflows as well as your outflows of cash, which will be resulting from the firm's daily business, and through this they are going to earn profit or loss. So this is your operating activities. Always remember your daily business, your daily transactions. Yes. For example, cash, receipts from royalties, fees, commissions and other revenues, or when you're paying rent, that is also your daily activity. Yes, or everything will be included in your operating activities. So this is your first type of activities. So as you can see, Godrej, if we talk about Godrej, what is their main business? The main business is all these type of activities, correct? So this is their operating activities, correct, related to this air fresheners, soaps and hand washes, this different types of dishwash, everything whatever is included in that their main business is what their operating activities. Now coming to next, that is investing activity. Now investing activity means what? See, are you going to purchase table every day, vehicle every day, TV, furniture, every day you are going to purchase? No. Yes, once in a 5 years, once in a 10 year, you are going to purchase all these things. Yes, so means you are investing somewhere. Like you are purchasing gold, silver, you are purchasing land, you are purchasing building, you are purchasing vehicle. So you are purchasing assets which you are not going to purchase every day. Yes, and you will use these things for more than 12 months. And if you are doing so, then that is going to be classified under investing activities. So in this, when you are acquisition, you are doing like acquisition for simplified version for right now, you can understand as when you are purchasing. Disposal means when you sell. Yes, of long-term assets, and we know long-term assets means more than 12 months, and other investments not included in cash equivalents, means other type of investments which are not your short-term investments, or you can say daily operational investments, that is not your main business. So that is your investing activities. So cash outflows represent that you are doing expenditure for acquiring, or you just think about, wait, let me give you one example. So tell me, when you're purchasing car is your business? No. Your main work is what? You all are employees in bank. Yes, so your main business is you all are employees. But you are purchasing car, you are purchasing furniture. So that is your investment. Now tell me, when you are purchasing this car, so while purchasing this car, you are receiving cash or you are paying cash? What you are doing? You are purchasing car and you are receiving cash. Is it so? No. Correct? When you are purchasing car, you need to pay something. Yes, it's a two-way transaction. And every time you cannot be benefited. You are receiving asset also and cash also. Why they will give you this thing? Yes. So always remember, whenever you are purchasing, there is going to be outflow in case of purchase. In case of purchase. Now, let's take second example. Now, this is one piece of land which belongs to you. Now, you are selling to Mr. Y. Now, tell me, you are Mr. A. Now, tell me what will happen. At this point of time, you are selling this land. Yes, you are selling this land. You sold this land to Mr. Y. Now, tell me, what you are going to receive. Just think as a practical. What you are going to do. If you are selling me your land, yes, so what you are going to receive? You are only going to give me cash, or here I am going to pay you something. Correct? I am going to pay you something. Means if I am selling, if I sold you this land, I will receive cash. Then only transaction will be completed. No? So in this case, when you are selling something, there will be inflow of cash. Yes, so this is about your investing activities. There will be cash inflows when you sell and cash outflows when you purchase. Now, for example, cash payments to acquire property, plant, equipment, intangibles like trademarks, copyrights. Yes, all these things included in your intangibles. So these payments include those relating to capitalized developments, cost and self-constructed property, plant and equipment. So this is about your investing activity. So whenever you are purchasing, selling land, building, equipment, machine, computer, furniture, anything which you are going to use for more than 1 year, and that is not your regular business, then you are going to classify in your investing activity. Yes, for example, you can see here like table you are purchasing, chair, yes, JCB, this shelf you are purchasing, this factory you are purchasing for your business. So all these investments will lead to what? Investing activities. Yes, now next, financing activity. So till here we have completed your two types of activities. Operating activity means your daily operations. Yes, includes your daily operations, and here you can see again cash inflow, outflow, and this will give you net profit or net loss. Yes, this is about operating activities, what we have understood. Now, investing activities means when you are purchasing or selling long-term assets. So whether you purchase or sell, this will lead to investing activities. Now, for example, land, building, car, furniture, yes, computer, etc. So that is your investing activities. Now, let's talk about last activity, that is your financing activity. Now, always remember, finance means funds. Yes, this finance means funds. So here we are going to talk about fund arrangement. Yes, here we are going to deal and we are going to see how you are going to arrange funds. Now tell me, if you want 10 lakh rupees. What are the options you have? Tell me. If I'm asking that you want 10 lakh rupees. Now, what are the options you have and how you can arrange this 10 lakh rupees? If you are holding any fixed deposit, you will say, ma'am, fixed deposit amount I have. Then you can say, ma'am, let's take bank loan. Yes. Or you can say, ma'am, let's borrow from my friends. Yes or no? Through this, you can arrange this 10 lakh rupees. Of course. Yes. So whenever we are talking about funds, and what are the sources you have through which you can arrange the funds? By your own saving or when you are borrowing, means we are talking about funds, and that is your financing activity. How you can fund in any business, how you can arrange funds in any business. Now let's talk about as a business point of view. Now suppose this is Reliance Industries. So Reliance Industries, how they can arrange funds? First of all, Ambanis can invest in this company, yes, or they can take public borrowing. Now this public borrowing means they can issue shares and through that they can raise, or they can issue bonds, yes, or how they can raise through loan. So these are the ways through which any organization can arrange funds. So this is about financing activities. Yes, so financing activities can be useful in utilizing the cash generated through operating of any investing activities, means how you can arrange funds. Yes, so this can also utilize for increasing cash inflows in times of need. So this is your last type of activity known as financing activities, like cash proceeds from issuing shares or other equity instruments, cash payments to owners to acquire or redeem the equity entity shares. So everything, when you are taking loan and when you are repaying loan, that will be included in your financing activity. Okay? So what we can conclude here, we can conclude for financing activities when you are arranging funds. Yes, when you are arranging funds. Now, at the time of arrangement, as well as at the time of repayment, arrangement, or I can say when you are borrowing plus when you are repayment, when you are doing repayment of any loans, that will be included in your financing activities. Means fund arrangement we are doing. Yes, how we can arrange the funds, own amount, borrowing, correct? So this is about 3 types of financing activities, and mostly when we talk about this financing activities, you can use your own saving, you can use from bank borrowings, yes, you can take from your own profit, whatever profit you are earning, you can use that profit in your business, or you can issue stocks and bonds. So these are the different ways through which you can arrange funds. Now, let's start and solve few questions based on this. So for the purpose of preparing cash flow statement, which one of the following is considered as operating activity? A. Acquisition of machinery, B. Purchase and sale of goods, and C. Issue of debentures, D. Repayment of term loan. Tell me. So when we are talking about machine, means we are going to use this machine for more than 12 months. Yes, and this is going to be your investing activity. Now, if I talk about these two, the issue of debentures, repayment of term loan, means we are talking about funds. And when we talk about funds, that is your financing activity. Okay, so the correct answer is answer B. Purchase of goods for sale. Next. For the purpose of preparing cash flow statement, which one of the following is considered as investment activity? Investment activity. A. Buyback of shares, redemption of debentures, manufacturing of goods, disposal of machine. Now, manufacture of goods means here this is your business. Yes, or you can say this is your core operations. Now, when we talk about core operations business, that is your operating. Yes. So this is not your answer. Then, a buyback of shares and redemption of debentures means repaying of borrowed amount. Okay, if you don't know what is the meaning of shares and debentures, then understand it as a way through which you can arrange the funds. So that's why I'm writing as a borrowed amount when you are repaying. So that is going to be your financing activity. So here correct answer is disposal of machinery. So when you are purchasing machinery, that is also your investing, and when you are selling that machinery, that is also going to be your investment activity. Yes. Then next, the cash flow statement primarily provides information about what? Profitability of the company, financial position of the company, cash inflows, outflows of the company, revenue and expenses of the company. So see, profitability is given by your P&L account. Yes, financial position given by your balance sheet. Revenue and expenses, we have an income and expenditure account. So as per this, your correct answer is answer C. Yes, you can understand what are your cash inflows and what are your cash outflows. So correct answer is answer C. Now next, okay. Which of the following is included in operating activities section of a cash flow statement? Purchase of equipment, cash received from customers, issuance of shares, payment of dividends. They are asking that what you are going to include in operating activities. Purchase of equipment? No. This is your investing activity. Yes. Issuance of shares and payment of dividends, these both are your financing activity. Correct answer is when you are purchasing, selling on a daily basis. So your customers will pay you. So that will lead to operating activities. So correct answer is answer B. So before we know that under which part and how they are preparing their accounts, first let's talk about few introductory part. A banking company is generally governed by the provisions of the Companies Act 2013 and specifically by Banking Regulation Act 1949. See, banks, though they are accepting and they are providing loans, but they need to comply with Banking Regulation Act. Yes, RBI norms. Every time, every week, month, we are seeing so many amendments. So bank needs to follow those amendments along with Companies Act 2013. These are the two important acts for banking companies. Then we have some major institutes that carry banking business in India. We have nationalized banks, yes, State Bank of India, foreign banks having branches in India, then cooperative banks, regional, rural banks, then we have private sector, small finance, payment banks. So these are the different types of banks which are working in India. But what actually banks are doing, now let's talk about that. So, as per this section 5 of the Banking Regulation Act, here you can see bank accepts the deposit of money from the public. Yes, what is happening here? Here, bank is accepting deposits from public for the purpose of lending or investment. Yes, now bank takes the deposits from their customers, and when these customers require loan, bank is providing them loans also. So major feature of the bank is what? Accepting deposits and providing loans. And the deposits are repayable on demand or otherwise by check, draft, order or otherwise. So basically here we have seen the definition of bank. Yes, they are accepting and they are providing the amount to the required persons. Now, under this, we need to comply with different sections. Like first one, that is section 29, given under your Banking Regulation Act. Now, as per this section, section 29, this gives the format in the schedule 3. Now, format for what? Format for your balance sheet, for your P&L account. See, final accounts includes two things. Yes, balance sheet as well as profit and loss account. These are the two things which are included in the final accounts. Now, when we talk about this final accounts, we have one prescribed format. We have one prescribed format. That format is given in the Schedule 3 of the Banking Regulation Act. Yes. Now, here this format is issued by RBI. Who issued this format? RBI. So Form A talks about balance sheet, Form B talks about profit and loss account. Yes, so every bank, when they are preparing their final accounts includes balance sheet, P&L, they need to comply with this Form A and Form B. Now, as banking companies, they needs to close their books on 31st March every year. Every year on 31st March, this banking companies needs to close their book. Yes, this is your section 29. Now, when we talk about signature on financial statements, because for taking the approval that yes, these documents are genuine documents, for that we require signature. Yes, from authorized person. Now, who are authorized? Who can sign on this financial statements? So, in case of banking companies incorporated in India, means what? See, this is our India. And if we talk about State Bank of India, yes, if we talk about any other banks like Axis Bank, no, Axis Bank, no, not Axis Bank. Let's take the example of ICICI Bank. Yes, so they all are incorporated in India. So now when they all are incorporated in India, they are known as Indian banks. Now, who are allowed for signature on their financial statements? That should be signed by the manager or principal officer of the banking company. Yes, who will signed by the manager or principal officer of the banking company, and by at least 3 directors. For all the directors, in case number is less than 3. So now you need to take the signature from the manager or principal officer. Yes, you can take manager or principal officer, but along with that you need to take the at least 3 directors signature. And if directors are less than 3, you need to take all the directors signature. So this is about your banking companies incorporated in India. Next is your foreign banking companies like HSBC Bank. Yes, so they are incorporated outside India, but they are working in India. So the manager, agent of the principal office in India, who is managing that bank, yes, who is the principal officer of that bank, that person needs to sign on that documents. So we have 2 points under signature. Yes, in case your bank is formed in India, then you need to comply with manager or principal officer plus 3 director signature. But in case your bank is foreign bank, then you need to take manager or agent of the principal office in India. So this is about signature on financial statements. Now, next part is section 30, again from Banking Regulation Act, which talks about audit. Now, first, banks will prepare their financial statements. Yes, they will prepare their balance sheet. Then they will prepare their profit and loss account. And after completion of that, only you will start your audit part. Yes, audit is what? Audit is examination of your documents. So when we are doing examination of the documents, here accounts must be audited by a person duly qualified under any law for the time being enforced to be an auditor of companies. If the candidate is having that eligible qualification, then they can start audit on that particular documents. Yes, so every banking company is, before appointing, reappointing or removing any auditor, required to obtain the prior approval of the RBI. Yes, so after completion of your financial statements by the bank, they need to conduct audit. And when they are doing this audit, yes, when they are doing this audit, they who can do this audit? Only the qualified candidates can do. Now, if banks want to appoint any new auditor, if they want to remove any existing auditor, or if they want to reappoint the same auditor, they need to take the prior approval from RBI. They need to take prior approval from RBI. So this is about audit. Audit is what? Audit is examination. Correct? So this is section 30, which talks about audit. Now, coming to the next section, that is section 31. Submit copies to the RBI. Now, first you have prepared your financial statements. After preparation, you will conduct audit. Yes, here qualified person will cross-check your documents. After audit, you need to submit your documents to your regulatory bodies. Yes, as per law. So here we need to submit to RBI. Submit copies to the RBI. Now 3 copies we need to submit. How many copies we need to submit? 3 copies. We need to submit 3 copies. Yes, 3 copies of what? Of balance sheet, profit and loss account. 3 copies of balance sheet and profit and loss account prepared must be submitted to the RBI, to the Reserve Bank of India. And in how many days? From the closing of your financial year, so within 3 months, you need to submit this copy to the RBI. Yes, from the end of the financial year, 3 months we have time. In that period, we need to submit to the RBI. So first, we have seen financial statements. Yes, in that you have form A, form B. Then next, you need to conduct audit. And after that, you need to submit documents to the regulatory bodies that yes, we have complied with your laws and regulation. So first, we are submitting copies to RBI as per section 31 of the Banking Regulation Act. Now here we need to submit how many copies? 3 copies. In how many time? In what time period? In 3 months from the end of your financial year. Yes, but if you want to extend this time period from 3 months, you can extend by taking the RBI approval for next 3 months. Yes, you can extend further 3 months, but remember, you need to take RBI approval that we want further 3 months again because we have not completed our audit or whatever reasons you have. And as per that, RBI will give you extension. So this is section 31, submit copies to the RBI. Now, next we have section 32, submit documents to registrar of companies. First, you have submitted your copies to RBI. Now, next we need to submit to the registrar of companies. Yes, Ministry of Corporate Affairs. So now, this Ministry of Corporate Affairs incorporated your bank. So we need to submit, this banking companies needs to submit 3 copies. Yes, 3 copies of its annual accounts and auditor's report. Annual accounts, whatever balance sheet P&L you have prepared, and auditor's report. Yes, your auditor will provide you one report after completion of that audit. So you need to submit 2 things. What are the 2 things? Annual accounts and auditor's report. And how many copies? 3 copies. Correct? To the ROC, that is Registrar of Companies. That is what? Registrar of Companies. So this is about submit documents to ROC. Now in this you have rule 15. Now rule 15 is again important. As per this rule, you need to publish your auditors and your accounts report document on your local newspaper. Now, what is that exact point? So, whatever the accounts and report you have generated, yes, you need to publish. And publish where? You need to publish on your newspaper, which is circulating in a place where a banking company has its principal office. So, in which place you need to circulate this? In your principal office address, whichever is the newspaper is circulating, you need to submit those documents. Which two documents? Accounts plus auditor's report within 6 months. And what is the time period? From the end of the time period, you have 6 months time. In that time, you need to publish your accounts and auditor's report in that newspaper. And in which newspaper? Which is circulating in your principal's office. Not all over India. No requirement of that. Wherever you have your principal office, in that area, whichever newspaper that is circulating, use that and publish your accounts and auditor's report. And what is the time period? 6 months. Yes. So this is about section 32 and rule 15. Okay. So now let's start and solve few questions. Achha, before we start this, let's quickly revise the important concepts. See, these are very important. They can ask direct questions based on this. Yes. So the first we have seen about the introduction part. Then next we have started with the definition. Okay. Then section 29 talks about RBI issued form A balance sheet, form B P&L account. Then who will sign? In case of banking companies, manager or your principal officer, along with that 3 directors signature we require. And in case of foreign banking company, you can take the sign from manager or agent of the principal office. Yes. Then next is your section 30, which talks about audit. Now in case of audit, who can conduct this audit? Only the qualified candidates. Now in case of you are appointing, reappointing, or if you are removing any auditor, you need to take the prior approval from RBI. Then section 31 talks about submit copies to the RBI. 3 copies of balance sheet P&L to the RBI within 3 months from the end of your period. Now if you want to extend further, you can extend by 3 months. But remember, you need to take the permission from RBI. Correct? Next. Section 32, submit documents to Registrar of Companies. Now, you need to submit documents to your Ministry of Corporate Affairs. So here also you need to submit 3 copies of your annual accounts and auditor's report. Now in case of rule 15, you need to publish accounts and auditor's report in your local newspaper, which is circulating in your principal's office area within 6 months from the end of period. Okay, chaliye. So let's solve few questions based on this. Okay. Banking companies in India are primarily governed by which of the following acts? Tell me. Companies Act 1947, Companies Act 2013, Banking Regulation Act 1949, or both B and C? Correct answer is both. Yes, B and C. Now, coming to next question. Under the Banking Regulation Act 1949, how many copies of balance sheet, profit and loss account must banks submit to the RBI? How many copies we need to submit to the RBI? 1, 3, 5, 10. Correct answer is 3 copies. Yes, 3 copies of what? Of your balance sheet plus profit and loss account. Okay. Then, next. As per Section 5 of the Banking Regulation Act, a bank accepts deposits of money for which primary purpose? Lending or investment, buying assets, distributing profits, payment of taxes. So tell me, a bank accepts deposits money for which primary purpose? For lending or investment. Yeah, lending or investment. Yes. Correct answer is answer A. Next. Under Section 29 of the Banking Regulation Act, what is the specified format for the balance sheet and profit and loss account that banking companies must follow? Tell me, A, B, C, D. You have 4 options. Form A, profit and loss account. Form B, balance sheet. No. C. Form A talks about balance sheet. Form B talks about P&L account. Yes. Form A, balance sheet. Form B, profit and loss account. Correct answer is your B.
So first, let's talk about what is computerized accounting. Yes. So, computerized accounting means what? An accounting system is one that performs the following function. First, it captures business transactions in the form of accounting entries. Second, accounting entries are then used to prepare financial statements. See, first, you are using your computers for passing daily entries. Now, daily transaction you can see like you are receiving cash. Yes, you are paying cash in your bank, yes, loan or deposits. So daily transactions are there, you are recording that. Along with that, you are preparing your financial statements. The financial statements means what? Balance sheet, profit and loss account, correct? You are using softwares only now. Then you are using this computers so that you can apply accounting standards, your rules and regulations related to your accounting. All the accounting standards in this you are using through this computer only. And if you want any different type of reports, yes, like you want stock report, you want your loan report, you want your interest report, easily you can generate with the help of these softwares. There is no requirement to pass same entries again and again. Yes. So if your system, if your computer is performing these type of activities, then you are going to say you have developed computerized accounting. Yes, this is the meaning of computerized accounting. If your computer can pass business transactions which you do daily, then your software or your computer can prepare financial statements. You and these financial statements are complying with your accounting standards or index. And if you want any separate type of reports, you can generate through this only. Then that is your computer is your computer is developed for computerized accounting. So this is the mean. Now, computer components. So basically, we can say we have physical components like hardware. Yes, then we have softwares, and then we have computer peripherals like supporting devices in your computer like printer, video monitor, keyboard, disk drive, etc. So these are the computer components. Then next is our computer language. See, like in accounting, we have sorry, in our business we have accounting language. Yes, like how to pass the entry, how to do the entries. Like same for computer, we need to learn computer language. First is your software programs. Now computer accounting system runs based on set of instructions. Yes, now when you are using your computer accounting system, there you are going to use some set of instructions, correct? Then programmer, a person who develops the computer software. See, everyone cannot develop it. Yes, like everyone cannot do the surgery. Yes, like for surgery we require doctor, and that too specific surgery doctor. Like that, for developing the computer software we require the experts, and those experts are known as programmer. Now next is computer software. So the instructions of the programmer are in a computer language in the form of computer program. Yes, so this is your computer software. Then what are the accounting softwares we are using nowadays like COBOL, FoxPro, etc. Okay, or on operating platforms such as Windows, Unix, etc. So these are the computer language, like who who is the person who develops the computer software, known as programmer. Now what is this computer software program? This is the computer accounting system which runs based on the set of instructions. Like in your bank you are using some applications, you are using some softwares. So that software is as per your bank requirement, hana. If you shift your bank, there they are going to use different softwares. So that is what computer programs. Now next, we have different types of computer. First is your analog computer, then next is your digital computer. Now analog computer means what? Here, analog computers are mostly used in scientific and mechanical fields, and they process data in a continuous form. Yes, so analog computers, here what they are using, here they are using scientific and mechanical fields. So basically this is used in engineering side. And next one is your digital computers. Now they accept data, convert them into a useful results by carrying out arithmetic operations. Now for passing accounting, yes, for preparing balance sheet, P&L, we are going to use this digital computers. And if you combine both digital as well as analog computers, this is going to create hybrid computers. This is your third type of computer. And hybrid computers, this is the combination of digital plus analog. Digital plus analog. Yes. So this is these are the different types of computers. Now, next, there are different terms which we need to use in our computerized accounting. Like first is our data, then next is record, data file or file, and system. So these are the different terms we are using when we are saying that we are doing computerized accounting. Data means here you are going to collect different bills, invoices, yes, about transactional details. That is your data. Then you are going to record in your system. Yes, you will maintain proper file, day wise file, month wise file. That is the record. And in that you have the different data file. Yes, and you are storing at some particular place. That is your system. So these are the terms used in computerized accounting. Then next we have omni-channel banking. Now omni-channel banking means what? This provides the same set of services to customers across all channels. Omni-channel banking, here your banks are using two things together. First, they are using branches. Yes, here they are using branches along with apps. Yes, if your bank is using both the things, physical as well as digital thing, then that is omni-channel banking. Like if you see SBI, yes, State Bank of India, they have their own branches, yes, and they have their own app. Yes, they have their own app, that is correct. So if that is what your bank is providing, means they are using omni-channel banking. Now here, omni-channel platform can improve marketing performance, increase customer retention, and simplify onboarding processes. So this is your omni-channel banking. Then users can access all banking service via website, mobile app, bank branch, call center, or even social media platforms like WhatsApp, Facebook, or Instagram, or any other available channel. Now, so many banks are saying that if you want to inquire about your balance, just give the reply on this number. We will provide WhatsApp text. Yes, um, just WhatsApp us. We will provide you bank statement. Just WhatsApp us. We'll provide you so many, whatever the possibilities they can provide through WhatsApp. So that is what omni-channel banking. What they're using, omni-channel banking. Then next you have neo banking. Neo banking means what? Is a bank that operates without a physical branch. Means here we are not having any physical branch. Yes, no physical networks we have. All the things we are doing through our what? Through our this neo this through digital platforms. Yes, so here neobank is a bank that operates without a physical branch network. The banking business is conducted entirely online. So the concept of neobanks has become appealing to tech savvy people. Now everyone is so busy in their life. Yes, they are having very less time to visit banks for every activity. Yes, for suppose bank statement, no one wants to visit bank. Yes, for loan, yes, no one wants to visit bank. FD opening, all this PF opening, no one wants to actually visit bank. So now what banks are doing, or this different providers are doing, they are opening totally digital bank. Yes, while sitting home you can open your bank account, you can take loan, you can create your investments. So if your bank is doing everything online, no physical branch, then they are using Neobanking. So what are the advantages? Simple account opening procedure, and that is lower cost. Lower cost for bank as well as for this customers. Yes, banks, there is no requirement to arrange infrastructure. Yes, there is no requirement to arrange building, no employees, nothing. And same for customers, there is no requirement to travel. Yes, so this is the cost saving part for both the parties. So this is your neo banking, and remember this is very important. In exam they can ask direct questions based on neo banking and omni channel banking. Now we have seen about computers and few important banking channels which we are using now. So let's solve few questions based on this. What is the computerized accounting system? A. System that captures business transactions manually. No, manually. Yes. B. A system where accounting functions are performed using computers. C. A system that only prepares financial report. Only financial report. No. System that ignores accounting standards. Then how come you can say you are preparing financial statements? So correct answer here is your answer D. Because computerized accounting system, they need to uh, pass daily transactions also. Yes, then they need to prepare financial statements also by complying with Ind AS and AS. And finally, if you want any other type of reports, various reports you can prepare through your software. And these things are done not manually. Yes, you are using some software. So the correct answer is answer B. Next, what is a neobank? A bank that operates entirely through physical branches? No, a bank that operates without any physical branches and conducts business online. Hmm, we can say this is correct, but let's read other options. C, a traditional bank with both physical and online transactions. No, then this is your omni channel now. So this is also not your answer. Then a type of investment bank focus on digital assets. No, correct answer is answer B. This is your answer. Okay, then next. Who is responsible for developing computer software for accounting systems? Accountant, programmer, administrator, auditor. See, who is developing your computer software? Programmer. Yes, they are the experts. Not accountant, not administrator, not auditor. Correct answer is your answer B. This is your B answer, not C. Then what are the physical components of a computer system called? Software, hardware, data, algorithm. Physical components of a computer system are called very easy, that is hardware. Yes. Then, which of the following is an example of computer peripherals? Keyboard, printer, disk drive. Disk drive. So correct answer is all of the above. Yes, these type of questions only they're going to ask from this unit, and this question is I think from your IFBF book only. Before we start the theory part, let's talk about few points related to business. Now, if I ask you about like how to start a business, yes, suppose if you want to start a business, you require funds. What is the first thing we want? We want funds. Without funds, can we start any business? No. First, we need to arrange funds. Correct? First, we want money. Then only we can start. We need to purchase goods. Yes. We need to take the property on rent. Yes. We need to appoint employees as well. We need to purchase assets as well. So first thing that we want, that is funds. But how we can arrange these funds? So we have two options. First, suppose you are starting your business, so how you will arrange your funds? Suppose you have some savings. Yes, your FD, your saving account. Yes, your jewelries you will use. So first you will use your savings. Yes, so whenever you are using your own funds, that will be your equity fund. Means when owners are giving any amount to their company, that will be equity fund. Yes, that is equity fund. But suppose you want more extra fund, Then what you can do? Then what you can do? Just think. You can take bank loan. Yes, you can take bank loan. And this bank loan is known as debt fund. Yes, so basically we have two types of funds. Equity, debt. Equity, owner's amount. Debt, borrowed amount. What you can say? Debt means your borrowed amount. Yes, your borrowed amount. Now there are so many ways through which you can do borrowing. First, you can take bank loan. You can go with debentures. Yes, you can issue bonds. So basically, bank loan, when you take from bank, like as you have taken loan from SBI, Axis Bank, ICICI Bank. Yes, debentures, bonds, which when you issue to public means when you're taking public loan. So that is your debentures, bonds. Okay. So these are the two ways through which you can arrange funds, and then you can start your business. Through this, you will purchase machines. Yes, you will purchase your stock. You will generate your income based on this funds. Now, there are different ways and the different forms of organization. Correct? So first we have that is sole proprietorship. Like uh, yes. You can see nearby your shops, yes, that medical shop, that confectionery shops, yes. So there is a single person who is manager, who is labor, yes, who is the owner of that shop. Correct? So that is sole proprietorship. Then next is your partnership firm. When two persons are coming together and they are working for their common goals, that is what partnership firm. Then next you have limited liability partnership. Now, limited liability partnership is the combination of company as well as partnership. Here you will see partners are coming. You and your friend both are working, but they have some limited liability. Limited liability means whatever amount they have invested, only they are liable for that much amount. Yes? Then next you have Hindu undivided family. So basically, if you're from Hindu family, Sikh family, Jain family, you can start your HUF. Yes, this is one of the way through which you can do your business. Then E1 is your AOP and BOI, Association of Persons or Body of Individuals. Association of persons mean when you are combining uh, like Mr. A, yes, then Reliance Industry, then Tata Company, yes, plus Mr. B. So if these type of person you see and they are coming together for any business or for any working, then that is AOP. But if you talk about body of individuals, means if you see Mr. A, Mr. B, Mr. C only, yes, when individuals are coming like you and me, you all are coming together, natural human beings are there, then that is body of individuals. Then next is your company. Company like your Reliance, yes, Tata, all these are your companies. Then cooperative societies. So cooperative societies is like your NGOs, yes, who are doing, they're working not for any profit motive. Correct? So these are the different forms of business, uh, or you can say organizations. Now, coming to the next part, that is financial decisions in a firm. Now, what are the decisions you will take in your organization? First, you will estimate how much capital you want. Yes, suppose here you want to start toy manufacturing. You want to start this business. Yes, you want to start your business. So what first thing you will see and what first thing you will talk? How much amount we need to invest? Correct? Suppose you decided that 10 lakhs at least we want for starting this manufacturing, this business. So this is your estimating the capital requirement. Now next thing we will talk about deciding the capital structure and composition. Means for starting this toy manufacturing we require 10 lakhs. But how we will arrange this? Yes, suppose now we have understood that 4 lakhs we will use our own saving and 6 lakhs we will borrow. Yes, we will borrow. Correct? 4 lakhs owner will bring and next 4 lakhs owner will bring and 6 lakhs they are going to borrow. So this is the structure they are framing. Then deciding on sources of funds. So sources of funds, like how they can borrow the 6 lakhs. They've identified that they will take from SBI bank loan. Yes, they will take from friends loan, correct? Then they will issue debentures, yes, etc. So means you are identifying the sources. Now your savings, now you have identified you will use your FD, your PF amount, yes, etc. So that is your sources. Next, use of long term funds. Long term funds means, see, long term means which you are going to use for more than 12 months. Yes, suppose you have taken bank loan, correct? Suppose you have taken bank loan for 5 years. Now, from bank you have taken suppose rupees 20 lakhs. Yes, so what are the uses of this 20 lakhs? You will purchase machine, yes, you will purchase equipment, you will acquire land, factory. So these are the sources which you need to check. So this is your use of long-term funds. Then corporate strategy, mergers and acquisition. Like what plans you will make. Yes, for upcoming 6 months, for 6 months, for 12 months. When you're talking about plans, that is your corporate strategy. Then next we will talk about use of short-term funds, working capital management. Basically, when you are starting your toy manufacturing, every day you will manufacture, you will sell your toys, you will purchase the raw material. Yes, so your working, your routine, your operational requirements is your working capital. And what funds you will use for this? You can take overdraft from the bank. Yes, from this overdraft, from this amount, you will purchase raw materials. Yes, you will pay salary. So that is what use of your short term funds. So these are the financial decisions in a firm you need to take. Now, next point is what are the objectives of financial management? Now, why we are doing this financial management? What actually it will help you in? So first is here to ensure adequate and timely support and supply of funds. Yes, when you are managing, when you are arranging, yes, when you are identifying the sources, your amount that you require. So basically, you will get the adequate amount on time. On a timely basis, you will receive the funds. Then you can decide your capital structure also, how much you will borrow, how much you will bring your own funds. Then you can see the compliance with regulations also, like if any income tax regulation is there, a GST regulation is there, income tax regulation is there, you can comply with that particular law as well. Then last one is your to ensure appropriate financial risk management. See, in every business you will identify the risk. Now how to manage those risks, that is the important part, correct? So before you start your working, you will talk about all these things. So that is your management of your risk also. Sometimes you can see there is a deficit in your business related to your funds. So how you will arrange that time, that is also one of the risks you will cover while talking about objective. Okay, so these are the few objectives. Now, next we are going to talk about fundamental principles of finances. First, we are going to talk about time value of money. Time value of money means whatever amount you are receiving today, that is more valuable than the amount you will receive tomorrow. Yes, like if we talk about Parle, this is one of your biscuit. Now, if earlier, like in 2010, if you if you would have paid rupees 10, you could have purchased that time 10 biscuits. Yes, 10 biscuits of this Parle-G. But today, when you are giving rupees 10, you are receiving only 5 biscuits. Yes or no? So now you can see for the same value, for the same amount of value, you are getting small amount. Yes, you are getting small quantity, smaller quantity. Earlier you used to get larger quantity, higher quantity, but now smaller quantity. So that is what time value of money. So a rupee received today is more valuable than a rupee received in the future. Then next, opportunity cost of money. Now opportunity cost of money means, suppose you receive four options. Yes, after clearing your college, you got four options. Or let's talk about three options you have received. First job offer you have received from bank, then you got the next offer for government office, then some private job you have got the job offer. Yes, and what are the packages? Let's talk about in bank you're receiving 15 lakhs per annum, government 10 lakhs per annum, and private suppose 12 lakhs per annum. So now tell me which option you will opt, which is the package you will select. Of course the bank one, है ना, because there only you are receiving the highest amount. And which is the next best alternative for you? Which is the next best option? Yes, that is your private one. Correct? So when we are talking about the next best opportunity, yes, that is your opportunity cost. Your next best opportunity is your opportunity cost. Okay, so it implies that if a person deploys his money on one investment, then he has to give up the opportunity to put this money on some other investments. Suppose, now let's take one more example. Suppose I have rupees 10,000 rupees. Yes, I have the option to invest on stocks or to purchase jewelry. Yes, if I'm purchasing jewelry, means I have actually foregone the option, the return from the stocks. So the amount that I have foregone, which I would have received from the stocks, that is what opportunity cost of money. Correct? Then last, not last, next is your risk and return. Now risk, whenever you invest in a stock market, we have the risk. Yes, we have the risk. Then return, how much amount you are receiving, that is what return. If you invest in Reliance Industries, how much amount you will receive? Suppose 10,000. If you are investing in 100 rupees you are earning, so that is your return. Correct? Risk means you can see the, you can face the losses, so that is what risk. So these are the few fundamentals about your principles of finance. Now next, building blocks of modern finance. Now this is important. You have four building blocks of modern finance: planning, what we need to do in future. Next, decision making, you are examining your point of view. Correct? You are taking decisions. Suppose you have four options, A, B, C, D. So when you have four options, which option is best for you? Correct? You will do the cost analysis, you will do the revenue analysis, and then you will select any particular field. So that is what decision making. Then organizing and directing, how to implement the decision that you have selected. Correct? So here you will develop your organization, here you will develop your departments. Yes, who will lead, who will be the manager here, that is what directing. And controlling means here you will uh, actually calculate your standards with your actual. And standard means your budgets, whatever decisions, or you can say whatever plans you have made, you will compare with your actual. And whenever you find any deviations, you will take corrective action. So these are the four building blocks of modern finance: planning, decision making, organizing, directing, and controlling. Now next, in this only you have required rate of return. Now required rate of return means what? as an investor, how much return I want if I'm investing any amount. Suppose this is a Reliance industry. I am investing 1 lakh. I'm investing 1 lakh. How much return I want from this company? How much profit I want from this company? That is what return. First thing what I will ask from this Reliance industry, that is my risk free return. Risk free return means what? Means if I invest this 1 lakh, yes, in FDs, I could have received 6% per annum. Yes, this is the return I can get. So this is the risk-free return because there is no risk. But as I'm investing in this Reliance industry, there are so many risks. Yes, market risk, company risk. So because of taking the risk, I want some advantages. Yes, I want some premium because of this risk. So I want this two things from Reliance industry. That is what required rate of return. The risk free part along with risk premium. Now how you can calculate the risk? With you have standard deviations. Higher the risk, higher the return I want. Yes, higher the risk premium I want. So this is your required rate of return. The firm has to decide on the rate of return it wants on its investment, below which it would not like to invest its money. Yes, total I want above suppose 6 plus risk premium amount. Below that I will never invest in that company. So that is your required rate of return. Next you have social responsibility. Now, you must have heard about CSR activities, corporate social responsibilities. Uh, Big companies, they need to comply with this social responsibilities because they are using society's resources. Yes, they are depleting our environment. So they need to provide some benefit, correct? So they need to comply with some social responsibilities. So basically, we have four categories: environmental, philanthropic, ethical, and economic responsibilities. For example, companies could have arranged blood donation, cataract surgery, medical checkup, yes, implementing child labor laws, or collection recycling of plastic waste, creating food bank, providing night shelter to homeless persons, sport complexes, providing safe drinking water. So these are the some examples which companies can use for social responsibilities. But we have one section that is section 135. As per that, if companies are complying with CSR, they need to especially check this legal aspect. So the first point is, if company is actually statutorily required to spend. If companies needs to comply with CSR, then they need to give at least 2% of their average net profit. Yes, 2% of average net profit. Now, how to calculate this average net profit? For calculating average net profit, they need to take 3 years previous financial year profit, and with this they will calculate current financial year CSR. Yes, most of the companies in India, they need to comply with this CSR, and as per that at least 2% of their average net profit. Now how to calculate average net profit? By taking 3 previous financial year's data to calculate current year CSR amount. Yes, and companies, if they are complying with CSR, they need to disclose the activities, their detail, and where they are complying it. So, as in their board report, also they need to show this. And as per section 135 of the Companies Act, they need to comply with CSR activities. Yes, so with this we have completed your overview of financial management. Now let's talk about and let's solve few questions. Which of the following is a part of financial management decisions? Investment decision, financing decision, dividend decisions, or D, all the above? Tell me. Can you tell me the correct answer? Here, Which of the following is a part of financial management decision? Tell me. Financial management decision will be taking investment decision, dividend decision, or financing decision. Tell me, what do you think? Which is the part we need to comply with? See, which of the following is a part of financial management decision? As a financial management decision, we are going to talk about investment decision also, financing decision also, and dividend decisions also. So all of the above. Then next, what is an essential component of organizing and directing in financial management? Tell me. What is an essential component of organizing and directing? Providing the right leadership, ignoring decision making, reducing planning time, avoiding organizational structure. All these three things are talking negative. Yes, and when we are implementing something, we require right leadership. So correct answer is answer A. Next, the function of financial controlling involves what? Continuous monitoring of activities, stopping after decision making, ignoring deviations from the plan, avoiding financial records. So, what is the function of this controlling? Here, you will set your budgets or you will use a plan with your actuals. You will compare, and if any deviations are there, you will control it. Yes, so the correct answer is continuous monitoring of activities, stopping, ignoring, avoiding. Again, all these three things are negative. What does opportunity cost refer to? The total amount spent on an investment, value of the next best alternative foregone. Answer B is your correct answer. So, with this, we complete your today's unit deal. So, first, let's talk about what is this ratios. So, for this, let's take one example. Suppose I am saying this is a Reliance industry, and if I am investing 1 lakh rupees, yes, if I'm investing 1 lakh rupees, after 1 year, I can earn profit equal to 10,000. Yes, 1 lakh I invested in this Reliance industry, and the return after 1 year I'm going to receive, that is 10,000. Correct? So here everything is given in absolute figures. Yes, 1 lakh, 10,000. So these figures are very easy. On the other hand, if I'm saying I invested 1 lakh, but I earned 79823.33 something, then that is going to be very difficult. Yes, like what is actual return that you are earning. So every time you are taking absolute figures, that will be very difficult for you. But if I'm saying that I am earning profit equal to 10%, you can understand easily. Yes, means whatever amount I'm going to invest, I will earn 10%. If I invest 2 lakh, I will earn 10%, means 20,000. Yes, if I invest 3 lakh, I will earn 10%, means that is 30,000. So if I am getting the ratios in place of absolute figures, things are becoming much easier. Yes, because you can use for smaller data as well and for bigger data as well. So that is the benefit of this ratios. Ratios uses the relationship which you can apply every time when you are seeing the data. Correct? Always calculating from a smaller data, bigger data, that is very difficult. Yes, no one is having that much time. So always we try to simplify the things. So how we simplify the things? Through setting some relations. And how we have used this relations? By using ratios. Yes, you can easily get any idea whether you invest 10 lakh rupees, 15 lakh rupees, or 10 rupees also. With the help of 10%, you can calculate the profit for each and every cases. Yes, so this is what the meaning of ratio. But here we are going to talk about accounting ratio. So accounting ratios, again this will talk about the relationship which we are going to express in mathematical terms, and between accounting figures which are connected with each other in some manner. Generally, when we are talking about accounting ratios, we are going to use your financial statement. Yes, and what are the things we include under this financial statements? That is your balance sheet and profit and loss account. Balance sheet talks about your financial position. Yes, this talks about your assets and liabilities. On the other hand, P&L talks about your profit or loss that you have incurred during the financial year. So when we're talking about accounting ratios, we are going to use your balance sheet and P&L account. Yes, but while setting the relationship to make the things simplified. Yes, so this is the meaning of accounting ratios. Now, what are the uses? Things are going to be simplified. Yes, simplify financial statements. If I'm saying I'm earning profit, that is 15%. Yes, so whether if I earn 1 lakh, yes, whether I invest 2 lakh, whether I invest 3 lakh, I know about my profitability. Yes, I will just multiply with 15% and I will calculate the absolute figure. So this 15% gives me the simplified financial statement. This talks about the simplified version of my this financial statements. Yes, this helps in to facilitate inter-firm comparison. Suppose if I am having 1 lakh rupees, yes, now I want to invest. So I have two companies. One is your Reliance, one is your Tata company. Now, if I talk about your profitability ratio, so with this I've understood if I invest 1 lakh, Reliance will give me 15% return, whereas Tata will give me 20% return. So as a rational investor, in which company I'm going to invest? Of course, in Tata company. Yes. So this is how I can use the accounting ratios for inter-firm comparison. Correct. Next is your intra-firm comparison, comparing your own company. Means this is your Reliance Industry, and I invested in previous year. Yes. So that year the profit I have seen that is 10%. Current year, your profitability is around 15%. Next year, we are expecting we are going to see 20%. So you can see there is a growth in your profitability. This is also you can use in case of intra-firm, means same company. Within the same company, when you are comparing previous year, current year, future year, you can use this ratios. There is no requirement to use again and again your this absolute figures. Correct. And last is helps in planning. Now how to plan about future, what strategy to opt. Yes, so these are the uses of accounting ratios. Now we are classifying ratios into two parts. First is your traditional classification, next is your functional classification. Now under traditional classification, profit and loss account ratio, balance sheet ratio, composite or interstatement ratios. Profit and loss account ratios means we are going to use profit or loss. Yes, profit and loss account ratios, you're going to use profit and loss. Balance sheet ratios, here you're going to talk about your assets and or your liabilities. Yes, with this you are making your comparison. Composite means you're going to include your both the things, that is your balance sheet as well as your P&L account. But this three methods which you have seen under traditional, this one is your old ways. Yes, this is your old ways. Now we are not using this. Now we are using functional classification. Now under this functional classification, as per the functions, we are deciding the ratios like profitability ratio, turnover activity ratios, financial or solvency ratio. Now this again divides into two subparts, that is short-term solvency or liquidity ratio, or B long-term solvency or solvency ratio. Yes, so these are the three major classification under your functional classification: profitability, turnover, and solvency ratio. Now again under this solvency ratio we have two subheads. short-term solvency ratio or liquidity ratio, long-term solvency or solvency ratio. Okay, so these are the classification of your ratios. Now, let's start with the first ratio, because see, in your bank, the most widely used ratios is your this current ratio. Okay, after this you are using this liquidity ratio, DSCR ratio, yes, earning per share ratio. So let's talk about these ratios. So first one is your current ratio. Current means we are talking about present. Yes, always remember, current means we are talking about present. At present, what's going on? That is what we are going to calculate. So this ratio indicates that the firm's commitment to meet its short-term liabilities. Now, short-term liabilities means liabilities whose life is less than 12 months. Yes, less than 12 months, like for 1 month, 2 months, 3 months. So that is what current ratios. Yes, whenever you are talking about your at present moment, yes, that is your current you are going to use. Now, here you need to use one formula, that is current assets divided by current liabilities. So basically, as per this equation, as per this formula, we are identifying about your current situation, that whatever you are doing, yes, whatever you are owning, whether that is actually, you can use it for recovering your obligations or not. Yes, that is what current ratio talks about. So basically, here we are going to take current assets. What are your current assets? Like your cash, inventory, yes, your routine activities, then your debtors, yes, etc. Then what are your current liabilities? Liabilities, that is your obligation, like your short-term loan. Yes or no? Short-term loan, bank OD, yes, etc. So if you're paying less than 12 months, then that is your current liabilities. Same, your cash, inventory, debtors, which you're going to use in your regular day-to-day activity. So basically, if we talk about your cycle, yes, first you arrange cash. For starting your business, you arrange cash. With this, you purchase your raw materials, yes or no? And then you will do the production. Then you will do production of this raw material to convert it into finished goods, and then you will sell, and after selling your customer will pay you again cash. So whole this activity, whole this cycle is your working cycle. Yes, this is your working capital cycle. So basically, when you're talking about this cycle, this is your current cycle. Yes, your daily activity, your operational activity cycle. So whatever you are doing on your operational, operational days, that is your current thing. Now, for calculating the current ratios, you are going to use current assets divided by current liabilities. Means whatever assets you are owning, like cash, inventory, raw material, finished goods, yes, the cash you are receiving from the customers, that is your current assets. Whether this current assets are enough to repay your current liabilities, yes or no. That is what current ratio talks about. Current liabilities like short-term loan, bank OD, yes, borrowing from your friend for 1 day, 2 day, 2 days, yes, then market securities whose life is less than 3 months. So that is what current liabilities. So if I say I have 500 current assets divided by 300 current liabilities, means here I have current assets, means I have, asset, this is my current asset and this is my current liabilities. So I can recover 300, and after recovering or after paying this current liabilities, I am going to see my working capital, that amount which I can reinvest in my business. So that is what your current asset minus current liability talks about. Means I have current assets 500. If I pay my current liabilities, then also I can see my working capital, that is 200. Yes, so this is your relationship between current assets and current liabilities. Means easily you can repay your current liabilities with your current assets only. So here current assets include cash and convertible assets. Convertible current liabilities includes liabilities payable within a year. And what is the satisfactory ratio we have? Your ideal ratio is going to be 1.2 to 2. Yes, the ratio of current ratio needs to be between 1.2 to 2. Now here your working capital is what that you are using for running your business. Yes, you are using this amount for running your business. That is what working capital, or you must have heard about net working capital also, after subtracting current assets minus current liabilities. What is the formula for current ratio? Current assets divided by current liabilities. So this is about your current ratio. Let's do the practice. Company has current assets of 1,20,000. Current ratios 60,000. What is your current ratio? Current ratio equal to current assets divided by current liabilities. 1,20,000 divided by 60,000. So 1,20,000 divided by 60,000, this is your 2:1. Yes, your correct answer is answer C. That is 1,20,000 divided by 60. Okay, means your current assets are 2 times more than your current liabilities. Means you can recover your liabilities and then also you will be seeing some excess amount. Yes, so this is your current liability. Let's calculate one more. Current ratio is equal to your current assets divided by current liabilities. In this question, current ratio is 2:1 and current liabilities are 80,000. What is the current assets? Now, these type of questions they are asking in exam. When they are giving the current ratio like 2:1 and current asset is a missing data and you have current liabilities, that is 80,000. So your current asset is going to be, just do the cross multiplication. So this is going to be your 1,60,000. Yes, correct answer is answer D. These type of questions they are asking in exam. Okay, now coming to the next ratio, that is a liquidity ratio. Now liquidity ratio means how fast you can arrange your funds. Yes, suppose in case of emergency you want 10,000 rupees, how you can arrange your 10,000 rupees from your bank, from your cash. Yes, if you hold any securities you will sell on your stock market. So how fast you can arrange your cash in case of emergency, that is what liquidity ratio talks about. You can call this liquidity ratio as acid test ratio or quick ratio. Now this is important in exam. They ask even question based on their names. Yes, what are the other names of liquidity ratio? Acid test ratio, quick ratio. Yes, acid test ratio and quick ratio. As per this, you are calculating how fast you can arrange your funds. So remember here you are going to use your liquidity ratio. Liquidity ratio. So liquidity ratio equal to liquid assets divided by current liabilities. Current liabilities whose life is less than 12 months. But what is this liquid assets? See, how to calculate liquid assets? Current assets, just now we have seen, minus your inventories. Minus inventories, prepaid expenses, and if you have paid any advance tax. Means inventories. Now if I'm doing toy manufacturing, yes, toy business, and this is my inventory. Yes, toys which I am holding in my godown, that is my inventory. So can I immediately convert this raw materials toys into my finished goods, or I can sell it? No. For selling this toys, I require customers. Yes, unless and until I'm not getting any customers, I cannot convert it into cash. So that is the reason inventories are not your liquid assets. Now, prepaid expenses, it already means you have paid your, suppose, rent paid. Yes, advance rent paid for 5 months, 6 months, means I have already paid it. Just now I will utilize the benefit. I'm not going to receive any cash, I'm just going to receive benefit. Yes, so that is again we are going to subtract it. Then advance tax. while paying TDS, yes, while paying TCS amount. So that is the advance tax we are paying. Yes, so already you have paid it. Can you receive afterwards this tax? No, unless and until you are filing your income tax return and if you are receiving any refund. Otherwise, there is no guarantee of receiving this advance tax. Correct? So from current assets, we need to subtract these three things. Inventories, prepaid expenses, advance tax. So this will give you liquid assets, okay, divided by current liabilities. And what we need to subtract? Prepaid expenses, stock, or you can say inventories and advance tax. Generally, we say quick ratio. If equal to 1, that is going to be satisfactory ratio. Now, let's solve question based on this. Current assets equal to 1,50,000, inventory 50,000, prepaid expenses 10,000, current liabilities 60,000. What is the quick ratio? Quick ratio equal to current assets minus inventory minus prepaid expenses divided by current liabilities. So current assets equal to 1,50,000 minus 50,000 minus 10,000 divided by 60,000. So what is your quick ratio? 1,50,000 minus 60,000. So this is your 90,000 divided by 60 divided by. So your correct answer is 1.5 divided by 1. Correct answer is your answer A. Okay. Let's solve one more ratio. Cash equal to 40,000, marketable securities equal to 20,000, current liabilities 80,000. What is the uh, cash ratio, or you can say here quick ratio? Yes. So what is your quick ratio here? Again, always remember, if inventories, prepaid expenses are not given, just add whatever assets you can see. Yes, in your current side, add your cash plus marketable securities divided by current liabilities. So that is your 40,000 plus 20,000 divided by 80,000. So 60,000 divided by 80,000. 0.75 is to 1. So this is your satisfactory ratio. The answer is no, because we want quick ratio above 1. Yes, we want above 1. So this one is your satisfactory ratio, but this is not your satisfactory ratio. Okay, this is your answer. Now, let's solve one question based on your data given here. Now, this type of questions they are asking in exam. So, ABC Limited is a medium scale manufacturing company engaged in the production of consumer durables. Consumer durables. The finance department of the company is evaluating its short-term financial health for the year ending March 25. Now, the company has reported the following financial data. So inventory, trade receivables, cash bank, short-term, prepaid, current liabilities. Based on the above data, identify the correct current ratio and quick ratios. So we need to calculate two things. First, let's calculate current ratio. Current ratio equal to current assets divided by current liabilities. So current assets, you are going to add inventory, yes, trade receivables, cash, plus short-term investments plus your prepaid expenses divided by current liabilities. So here add 6 lakh plus 8 lakh plus 2 lakh plus 4 lakh plus 1 lakh. This is going to be your 21 lakh divided by 10 lakh. 6 lakh plus 8 plus 2 plus 4 plus 1. Yes, that is a 20. That is your 21. So your current ratio is your 21 lakhs divided by 10 lakhs. This is your 2 is to 1. Yes, 2 is to 1. Now, let's calculate quick ratio. What is the quick ratio? Liquid asset divided by current liabilities. Now see, for calculating liquid asset, you can go with two things. Either go with A1 or you can go with the B1. So in case of calculating liquid assets with A, use your current assets minus your inventory minus prepaid expenses. Yes, so means current assets equal to 21 lakhs minus inventory 6 lakh minus your prepaid expenses, that is your 1 lakh. So this will give you 21 lakh minus 6 lakh minus 1 lakh. That is your 14 lakh. Now you can do addition just by taking trade receivables plus cash and bank balance plus short-term investments. See, 8 lakhs plus 2 lakh plus short-term investment, that is 4 lakh. 8 plus 2, 10 plus 14. See, both the ways you can use for calculation. Both will give you the same answer. Yes. So liquid assets equal to 14 lakhs divided by current liabilities going to be same, that is your 10 lakhs. So 14 lakhs divided by 10 lakhs equal to 1.4 is to 1. Yes, so this is how we need to calculate current assets and quick ratio. Okay, now we have one more very small ratio which you are going to see again and again, that is your earning per share. Now, earning per share EPS tells about the earning per equity share. Means if you are investing or if you are purchasing one share, what is the return you are receiving? Yes, in your one share, if you purchase of Reliance, what is the earning you are receiving? So that is what earning per share. Net profit after tax and preference dividend divided by number of equity shares. It means if you purchase one share of your company, of that any company in which you have invested, what is the return you are receiving? That is what earning per share talks about. Yes, so here your earning per share formula is net profit after tax and preference dividend divided by number of equity shares. So first you calculate profit before, or you can say first you get earning before interest and tax. From this you subtract the interest amount. From this you receive profit before tax. Finally you subtract tax amount, and then you receive profit after tax. You subtract the preference dividend, and finally whatever the earning is available, this belongs to your shareholders. Yes, we're talking about this earning, but this earning is given in total. We need to calculate per share. So how we can calculate? By dividing by number of equity shares. Okay. Let's solve one question. So net profit after tax 5 lakh, preference dividend 50,000, number of equity shares 90,000. So earning per share equal to net profit after tax minus preference dividend divided by number of equity shares, means ultimate amount available to your owners. So 5 lakh minus 50,000 divided by 90,000. 5 lakh minus 50,000 divided by 90,000. Correct answer is 5. Means if you purchase one share, you will receive 5 rupees earning. That is what earning per share talks about. Okay, let's solve one more question. If a company reports a net income of 10 lakhs, issue 2 lakhs equity shares with no preference dividend, your earning per share is going to be net income divided by number of equity shares. That is your 10 lakhs divided by 2 lakh. So your answer is 10 lakh divided by 2 lakh. Again 5. Yes, earning per share is of 5. If you invest one share in
Invest. So interest means when money is lent, yes, the borrower usually pays a fee to the lender. That fee is called as interest. Yes, when you are borrowing some amount and you're paying any amount to your giver, yes, that lender. So that is what interest, that fee we are paying for using that amount. That is interest. So that interest can be simple or compound interest. Yes, that interest can be what? Simple or compound interest. Yes, we can see there are two types of interest. Simple interest, compound interest. Yes. Now, what is simple interest? Simple interest means here amount of interest calculated as a fixed percentage of the amount borrowed or lent at the start and is paid on receipt end of the contracted period. So basically whatever amount you have borrowed, every time you are paying fixed percentage on that fixed amount only. Yes, like in suppose if I am depositing 1 lakh rupees and every year bank said that we will pay that interest 6% on 1 lakh rupees. So that means every year on this principal amount I am receiving, so that is simple interest. Yes, so what formula I am going to use here? Interest equal to principal into R into T. PRT. Yes, interest equal to P into R into T. Principal amount, that is our base amount. What we are borrowing as a loan, what we are depositing, yes, that is your principal. Rate means whatever the return we are receiving. Yes, whatever the rate we are paying on that loan or we are receiving because we are depositing. Correct? And the last is your time. For what time period we are depositing or for what time period we are taking this loan. So that is your T. P into R into T. This will give you interest amount. Yes, this will give you interest amount. Okay. So let's solve one question based on this. Find the simple interest on 5,000 at 8% per annum for 2 years. Now here we need to calculate simple interest. P into R into T. Principal amount is your 5,000 into 8% and 8% is your per annum. Correct? 8% is your per annum. But here in question they are asking for 2 years. So what is the time period? That is 2 years. So multiply this and tell me the answer. 5,000 into 8% into 2. Yes. So what is your answer? Your answer is 800. Correct answer is 800. If you multiply with just 1, like 5,000 into 8% only if you are doing, then that is 400. For first year, you are receiving 400. Yes, but here in question they are asking about second year. That's why your correct answer here is not 400. Answer is your B. This is how we need to calculate simple interest. Now, coming to the same simple interest formula. So, simple interest questions can be solved by applying the following formulas also. Just now you have seen that simple interest equal to P into R into T. Yes, you can write this as P into R into T. Same thing. Yes, we are just removing the sign. We are just writing both the R and T together. That means also multiplying. Yes. So you can write like this also. Or for accumulated amount. Yes. If someone is asking like after 2 years, yes, after 2 years, what is the total amount? What is the total amount? Like in our previous question, if someone asks you, what is the total amount? Yes, so what you will do? You will add 5,000 plus 800. So this is your 5,800, means principal plus interest. This is your 5,800. Yes, and this 5,800 is your A amount, accumulated amount, A amount. This is the final value of a deposit at the end of the period. Yes, that is a total amount, correct? Then P is your principal amount, initial amount of the deposit. R is your annual interest rate, that is expressed as a decimal fraction, and I is your interest after T years. What is the interest you are going to charge or you are going to receive? Yes. Now, when we are talking about this R now, so R means 8%. Yes. Now, if you want to write in decimal, you can write it as 0.08. Yes. Now, if you want in fraction, 8 divided by 100. These are the different patterns which you can use for calculating the rate. Yes, 8% can be written as 0.08 if they are asking as a decimal, or they can write in fraction also, 8 divided by 100. Everything is same only. Yes. So this is about the formula which is related to your simple interest. And remember this formula. Yes, A equal to P into I equal to P into R into T. This is very important when you are upgrading this concept. Yes, when you are seeing the difficult concepts, that time we are using this formulas. Chali. Let's solve one more question based on this. Mohan invested 5,000 in a company's fixed deposit with an interest rate of 9.8%. How much interest would he earn in 3 years? Now again we need to calculate. Here that simple interest, P into R into T. Yes. So here we are saying that every year that Mohan will receive same interest rate, that is 9.8%. So here 5,000 equal to, okay. Here we are solving this question that every year you are going to charge that rate on this principal amount only. Okay, here we are not doing any compounding. We are saying that every year on this 5,000 only we are charging. So 9.8% into 3 years. So what is your simple interest? 5,000 into 9.8% into 3. So correct answer is 1470. This is your simple interest. This is your interest answer. If in question they are asking you about the accumulated amount, yes, or total amount, accumulated or total amount, then P plus I. P means 5,000, I means 1470. So what is your accumulated amount? Plus 5,000, 1470. So this is your 6470. This is your accumulated answer and this is your interest answer. Yes, so how much interest would he earn? That is 1470. This is how we need to calculate simple interest. Yes. Now, coming to one more question. All these questions are from your IFBF book. Yes, that study material that is provided by IFBF. So we are solving from that book only. Let's solve the next question. A student purchases a computer by obtaining a loan on simple interest. Yes, already in this question they have provided you that this student obtained the loan on simple interest. The computer costs 60,000 and the interest rate on the loan is 12% per annum. If the loan is to be paid back after 2 years, so here we need to calculate two things. Okay, first the amount of total interest to be paid. Second, the total amount to be paid back after 2 years. First, let's calculate. First part, that is amount of total interest to be paid. We need to calculate means interest P into R into T. Principal amount, that is your 60,000. Rate is 12% and time period after 2 years. What is your interest amount? 60,000 into 12% into 2. So your interest amount is 14,400 interest. Now, second part, the total amount to be paid paid back after 2 years means we need to calculate accumulated amount. So how to calculate accumulated amount? That is your P plus I, principal plus interest. Principal amount is your 60,000 plus interest amount is your 1440. So this is your 7440. This is your answer. This is your answer. Okay. So this is how we need to solve your simple interest in case they are asking about total amount like accumulated amount, or if they are asking interest calculation. This is how we need to calculate. All these questions, this one, previous one and this one, all three questions are from your IFBF book. Okay, so the chances are there that they can ask the direct question based on this. Now, coming to the next part, that is your compound interest. Okay, compound interest means interest here we are receiving. Whatever interest we are receiving, we are reinvesting it. Okay, so the total amount that we are getting, okay, whatever interest we are receiving, we are not withdrawing, we are reinvesting. So what is the total amount we are generating? That is what compound interest is talking about. So compound interest means if the interest is charged more than once during the period and the interest is reinvested, we need to compound the interest. Okay? Suppose today I am investing rupees 100. After 1 year, I am getting along with interest this amount as 110. Okay? So on this, I suppose I charge 10%. Now again I am investing this 1110 for 1 more year at the rate of 10%. So at this point of time, I am not going to calculate 10% on this 100. I am going to calculate 10% on 110. So 110 into 10%, that is going to be your 11. Yes, that is going to be 11. So 110 into 10%, that is your 11. Means after second year, I am going to receive 121. This is the total amount. This is the total amount. This is not your simple interest that every year you are going to calculate on this principal amount. Every year on total amount we are calculating. Okay, whatever interest we are generating, we are reinvesting it, and again on that we are calculating the interest amount. This is what compounding is all about. Okay, so what formula we need to use here? A equal to P into 1 plus R divided by N whole to the power N into T. A means here the amount accumulated. Yes, after 2 years, what is your total amount? That is what accumulated. P means your principal amount. R is your rate of interest. Yes, like 6%, so 0.06, 6 by 100. That is your R. Number N means number of times per year the interest is compounded. If in a 1 year only you are getting quarterly returns, at that time we are using this N. When we are going to use N, when in a single year, like you are receiving quarterly return, yes, half yearly, weekly, if this type of return you are receiving, then at that time you are going to use N. Otherwise, no need to use N if you are calculating for per annum. Yes. Now, T number of years for which the principal amount is invested. So this is the formula which we are going to use for calculating compound interest. A equal to P into 1 plus R to the power T. Yes, if you are ignoring N, A equal to P1 plus R to the power T. ठीक है, if you are not receiving any quarterly, half yearly or weekly returns, at that time you can use this formula A equal to P into 1 plus R to the power T. चलिए, so let's solve one question based on this. Find the compound interest on 5,000 for 2 years at 10% per annum compounded annually. Means yearly interest we are receiving. ठीक है, no half yearly, no quarterly, yearly we are receiving. So let's solve this question. A equal to P into 1 plus R to the power N. Sorry, this is your T. This is your T. ठीक है, so P is your 5,000, 1 plus R is your rate of interest, that is 10%. I already informed you 10% you can write as 0.10 or 10 divided by 100. ठीक है, and time period is your 2 years. 2 years. Now how to solve this part? Let me explain you with the calculator. See, whatever in bracket they are given. So here they are giving 1.1 to the power 2. Hana, if you add this two things, 1 plus 0.10 power 2, means we need to calculate here square. Yes, we need to multiply this 1.1 2 times. 1.10 into 1.10 we need to do. For calculating square, we need to multiply the same thing for 2 times. Yes, suppose if I want to know what is the square of this 2, I will do what? 2 into 2 means 4. Hana? If I want to know the square of this 3, I will multiply 3 into 3, 9. Okay? If I want to know 4 square means 4 into 4, that is 16. That is what square means, Hana, when we are multiplying the same number 2 times. Yes, but how to calculate when decimals are given? So, with the help of this calculator, you can calculate it. Just type the base amount. 1.10 is your base amount. Type this on your calculator. 1.10, then multiply, press multiply button and just press 1 time equal to. Just press 1 time equal to, and on your screen you can see this amount is 1.21. Yes, or if you multiply this 1.1 into 1.1, you can see the same amount you are receiving, 1.21. Okay, this is how we can calculate the square root. Okay, once again I am telling you how to do this. I hope you are using your calculator for the calculation purpose. Hana, please use this calculator. Then only you can understand. Just by watching this session, you won't understand what we are doing. Just use this calculator along with me. Suppose here you have 1.15 to the power 2. So how to calculate with the calculator? Type this base figure, that is 1.15. Okay? 2 times when you calculate. When we want to calculate square, just multiply once and press equal to once. Again I am explaining. Type 1.15, press 1 time equal to and press 1 time multiply and 1 time equal to. So this is 1.3225. If I want to calculate 1.15 to the power 3, yes, if I want to calculate cube, type 1.15, press 1 time equal to button and this time press multiply button for the 1 time and press equal to button for 2 times, 1, 2. Yes, so your cube is going to be 1.5208. So what steps you can write over here? A, type base number. Okay. Then B, press multiply once, and C, press equal to button by 1 minus 1 time, n minus 1 times. N means, suppose here your power, n is your power minus 1. Okay? So if power is 2, press equal to button by 1 time. If your power is 3, 3 minus 1, press your equal to button for 2 times. If your power is 4, press your equal to button for 3 times. Okay? So this 3 steps we need to apply on this calculator. So let's solve this question now. 5,000 into 1.21. So what is the final answer? 5,000 into 1.21. 5,000 into 1.21. So here your answer is 6050. This is how we need to calculate compound interest. Again, let's solve one more question. Find the compound interest on 10,000 at 8% per annum for 3 years. So this is your total accumulated amount. This is your accumulated amount. If I want to know about the interest, I can subtract A minus P, means 6050 minus 5,000. So interest amount is 1050. Okay. Now let's calculate interest again. A equal to P into 1 plus R to the power T. T. P equal to 10,000. 1.08 to the power 3. Yes, means we need to multiply 1.08 into 1.08 into 1.08. This is what cube means. But for calculating with your calculator, first, what step we need to do? Type base number, that is 1.08. Yes, then B, press multiply button once. Yes, then press equal to button for n minus 1. N means your power minus 1 times. So here, for how many times we need to press equal to button? 3 minus 1 means for 2 times. Okay? Chali. So these are the steps we need to follow. Please type 1.08, your base number, then multiply button once, equal to button for 2 times. 1, 2. What is the answer on your screen? 1.2597. Yes. So 10,000 multiply by 1.2597. If you multiply with 10,000, this is your 12597.12. This is your accumulated amount. For interest, subtract this accumulated with principal amount. 12597.12 minus 10,000 if you will do, your answer is 2597.12. This is your final answer. This is your final answer. Okay. This is how we need to solve compound interest. Now, one more small topic we have that is very important again from the exam point of view, that is rule of 72. Rule of 72 means in how many years you can double your amount. Okay. If today I am investing 5,000 rupees, so in how many years I can get 10,000? What is the double of 5,000? 10,000 now. So in how many years I can get 10,000? For that I can use this rule, that is rule of 72. Rule of 72 you can use for knowing approximate number of years before your money doubles with yearly compounding. So this formula is 72 divided by R. This is the formula we need to use. Basic, very simple. 72 divided by R. Chali. So you have borrowed 1,000 at an annual interest rate of 6%. Using the rule of 72, calculate approximate how many years the borrowed amount will double if no repayment is made today. So can you tell me? 72 divided by R, that is a 6%. So in how many years? 72 divided by 6 means in 12 years your amount will double. Okay, your amount will double if you are not paying any amount today. Means after 12 years, this 1,000 will become 2,000. This is your rule 72. Okay, and remember, this is your interest part. But in this unit, we have annuities part also. For that, you can join my crash course, not crash course, you can join my upcoming batch, that is officers batch. Okay. Whenever we talk about any organization, or chali, let's take one example. Suppose I want to start one business known as Aarti Private Limited. Okay. This is the business which I want to start. Now, if I want to start this business, I require funds. Yes, without funds, can I start this business? No. For purchasing, yes, for appointing laborers, for purchasing raw materials, I require funds. Yes, I require money. Now, what are the ways through which I can arrange this money? I can use my own saving. Yes, I can use my own saving. Yes, I can use my FD account. I can use my salary. Yes or no? And what is the one more way through which I can arrange these funds? That is through borrowing. Yes or no? That is through borrowing. I can borrow from my friends. Yes, from my family, from bank, etc. Yes, so there are two ways through which I can arrange funds. So this own savings, when I'm using, when I'm investing my own amount, that is your equity. Because as an owner, when I'm sharing the ownership, yes, when I'm sharing the ownership, when I'm having the ownership, or if I say, so I'm going to say whatever amount I'm bringing, that is equity. But on the other hand, when I'm arranging the funds from family, friends, bank loan, yes, that is borrowing. That is borrowing. And this debt means you're borrowing only. Debt means borrowing only. So debt means a sum of money due by one party to another. When I'm borrowing from bank, I need to repay. I am going to repay interest. I'm going to repay that principal amount as well. So that is debt. Means here it creates the liability. Yes, that is what debt. Now, what are the sources you can see here? What are the different sources? Now, this sources is about funds. This source is about funds. So I can take FD. Yes, I can take amount from FD, or sometimes I can take loan against this FD also. Yes or no? This is one way. I can use bonds. Yes, as a company, I can issue some bonds to the public. Means I can raise amount through the public also. Then bank borrowing, like from SBI bank loan I'm taking, or other instruments like debentures. Okay? So these are the few ways through which I can arrange funds. Yes. Now, next important thing under this is your bonds and debentures, because mainly in this unit we are going to talk about the borrowing side. When we are using bonds, when we are using debentures, that bond side means that borrowing side we are talking about. So bond means and debenture means what? So bond means bonds issued by the government or by the public sector companies in India. Lower risk, more stable. Bonds, who is going to issue this? Public sector companies, again which is backed by government or government companies. Yes, government can issue the bonds, public sector companies can issue the bonds in India. So that is going to have lower risk and more stability. See, if anything is related to government, government will never give any higher risk. Yes, because government is not here to earn any profit. Yes, they are here to give the benefit for the society. Yes, so their objective is not to earn profit. That's why whatever bonds government are issuing, that is having lower risk. And if any instrument is having lower risk, that is going to give lower return also. Always remember this point. Lower risk, when risk is low, yes, you will get lower return. Yes, because if you are not taking any risk, you will receive minimum return as well. Yes, like if you use fixed deposit, there is no risk. So that's why there is very less minimum return. Yes, but if you invest in your share market, higher risk, higher returns. Correct? So next is your debentures. The private sector companies also issue bonds. But when private sector companies are issuing the instrument through which they are borrowing, that is known as debentures. That is known as debentures. Higher risk, more volatile. Higher risk, more volatile. Okay? If you invest in this Bombay Stock Exchange, National Stock Exchange, yes, if you're purchasing through this exchanges, Reliance Industry shares, Tata shares, share market, you must have heard. Then what we are purchasing through that market? Debentures. And debentures are issued by private sectors. Okay, and this gives the higher risk, and because of higher risk, as it is having higher risk, it will give higher or lower return? Higher return. No one can predict market. No one. Yes, so this is the difference between bonds and debentures. Okay, both the ways, what common thing we are doing in both the side, we are borrowing. Okay, sorry, coming to the next, that is bonds. Bonds. So a bond is a long-term instrument. Now long-term instrument means bond is going to have more than 12 months life, or security that pays a series of future cash flows consisting of interest payments over a period and redemption amount on maturity. Suppose what they are saying, let's understand with one example. Okay. Suppose if I want to take SBI bank loan, and this loan is for home loan. I have applied for home loan. Okay. Suppose I applied for 50 lakh home loan. Now tell me, what things I need to pay to this SBI bank? Interest? Yes or no? Interest as well as principal amount. Yes or no? Interest as well as principal amount. Correct? So when I am repaying it, because I have liability to repay principal amount, and for using the principal amount I am paying extra fee, that is interest. The same thing under bonds we are doing. As a company, this is Aarti Private Limited. Now Aarti Private Limited wants fund. Yes, now Aarti Private Limited wants fund. So what they can do, they can issue bonds. They can issue bonds. This is one instrument, and this instrument is issued, or let's say this is not private company, this is your limited. Yes, this is your PSU, Aarti Limited. So here we are issuing the bonds to public. Okay. So while issuing the bonds, this is the instrument we are transferring to the public, and from the public we are raising amount. Okay, we are raising amount from public. Now in this case, Aarti Limited, this is the first thing. Company is issuing bonds to the public, and public will pay or give amount to Aarti Limited. Okay, this is the first thing. Second thing, Aarti Private Limited, Aarti Limited company will pay timely interest on this bonds, because Aarti Limited will use amount which is raised, which they have raised from public. Okay, so for that they will pay interest, and at the maturity, like we have raised this amount for 5 years. So at the time of maturity, Aarti Limited will repay that principal amount as well. Okay, so this is what they are saying. As an individual, when we are taking any loan, we are repaying the interest and the principal amount at maturity. The same thing companies are doing. They are taking loan from bank, no, from public. That time they are issuing bonds. Okay, they are giving an instrument, one certificate that yes, we are borrowing. That is a proof, because this bonds will act as proof that we have raised from public. Okay, so this is your bonds. For example, a company issued a bond face value 1000, carrying a coupon rate 10% for 10 years. Here, what is the value of one bond? Here, the value of one bond. One bond, that is rupees 100. Okay, and coupon rate, that is interest that we are paying, is equal to 10% for 10 years, that is 10%. What is the interest payment we are going to make on this bond? That is 10%. Okay, coupon rate. See that when we are taking loan from bank and we are paying some interest rate, now that is the same thing we are paying here also, known as coupon rate. Okay, now interest is usually payable at fixed intervals, like semi-annual, annual, sometimes monthly. Semi-annual means your half yearly, then annual for 12 months, yes, sometimes monthly. For each month you are paying interest. So these are the some introduction of your bonds. First we have understood the meaning, then example, and then how interest here means your coupon rate, or you can say your coupon interest. Coupon means your interest only. So how you're doing your coupon payment. Okay, so this is about your bonds. Now there are different types of bond. So let's start with the first one, that is fixed rate bonds. Fixed rate bonds, like we have fixed deposit, FD. Okay, if bank is saying FD rate is 6%, means whatever amount individuals are investing, they will receive only 6% per annum. There is no change in this rate. Things are going to be fixed. Correct? Same thing we are going to apply in this bonds. If company, that Aarti Limited, is saying we are issuing bonds at the rate 12% per annum, that bond will hold 12% per annum till the life of that bond. Okay, suppose we have issued the bonds for life equal to 3 years. So for 3 years, each year 12% Aarti Limited will pay to their bondholders. Okay, now next is your floating rate notes. Floating rate, fluctuating. Yes, this is a variable coupon which is linked to reference rate of interest. If RBI is reducing their rate, they are increasing their rate. As per that, you can see the adjustment in the rates also. Okay, the rate is not going to be constant. Here you can see fluctuating. That is your floating rate notes. Next, zero coupon bonds. Now this is very interesting one, and this is important also. In exam they can ask you direct question based on this. So zero coupon bonds. Now zero coupon. See what I told you about coupon means. Coupon means interest. Now read it again with this term, zero interest bond. Zero coupon bonds means zero interest bond. Zero means nothing. Hana? So here the bonds will carry zero interest. So as a bond holder, how we are going to earn? See, let me tell you. Here is Aarti Limited. Yes, here is our bondholders who are ready to purchase bonds. But this time, Aarti Limited said that we are issuing zero coupon bonds. Zero coupon bonds. And if you talk about the actual value of the bonds, yes, if you talk about the face value of the bond, that every time this Aarti Limited was issuing, that is equal to rupees 100. Every time Aarti Limited used to issue rupees 100 face value per bond. Okay, for 3 years at the rate 12% per annum. Okay. So this was the thing earlier they used to issue. But this time they are saying we are issuing zero coupon bonds. We are issuing zero coupon bonds. Now what is the zero coupon bonds? Means they are issuing the same bond which they used to issue at 100, and then on that bonds they were paying 12% for 3 years. Correct? But this time they are saying we are again issuing the bonds, but this time we are issuing the same face value which is 100, but we are issuing at 80 rupees for same life, that is 3 years. We are issuing for 3 years only, but this time we are issuing at discount. See, the actual MRP, if you are not getting this thing, that biscuit packet is available for 10 rupees. Every time you pay 10 rupees for purchasing that biscuit packet. But this time, that shopkeeper is saying you can purchase that same biscuit packet for 7 rupees. Means here you received discount. Hana, you received discount. So here at the time of issuing, bondholders are giving 80 rupees and they are purchasing certificate. They are paying 80 rupees and they are purchasing certificate. But the twist is, at the time of maturity, this Aarti Limited will pay rupees 100. And this is how bondholders are gaining. See, ultimately, what is the total amount they are receiving as a bondholder? 100. And what is the invested amount? How much they have paid for purchasing one bond certificate? 80. So you can see here 20 benefit. And this benefit is known as zero coupon bonds. Okay, chal. Then one more we have, that is convertible bonds. Convertible bonds means at the time of issue, you are saying that we are issuing bonds, but after few years, you are going to give right to convert it into equity. At the time of issue, you are saying we are issuing bonds. Now, after 2 years, bond holders can convert it into equity. That is what conversion. Okay, this is conversion bonds. Here you are giving option to bondholders to exchange a bond with number of shares of the issuer's common stock. Common stock means here your equity. Means now, if your bondholders are ready to purchase this convertible bonds and they are ready to acquire equity, so now they will hold ownership. Okay, they will not receive any interest. So this is your one more type. Then let's do this part, that is valuation of bonds. Valuation of bonds means what is the true value of that bond? What is the true value of bond? Because when we are investing, what we are going to see, we are going to observe whether we are paying good amount, overpriced or underpriced. Okay, suppose if I am saying, for example, I want to sell this pen. Okay, I want to sell this pen, and I am saying I'm selling this pen and I'm ready to sell this pen for rupees 15,000. Suppose this is just normal pen. Okay, and I'm saying I can sell this pen for rupees 15,000. What you will think? Or let's increase the amount. Okay, suppose I'm saying I'm going to sell this pen for 1,50,000. So are you interested to purchase this pen? The answer is no, because you know it. This amount is over. This is overly priced. So you will reject it. But if I'm saying I'm going to sell this pen for rupees, suppose 100. So you can say, this is a good amount. You are ready to pay it also. So here you are doing a valuation. Whether the thing is actually that much worthy. If it is, you will pay. You will happily pay for that. But if it is not, you will never going to pay it. You will reject it. Yes. So for valuation, for knowing whether for knowing the value of that thing, whether that is overly priced or underpriced, or that is okay. For that, we need to do some valuations. So here we have valuation of bonds. So how you can value? You can value the bonds with the help of two things. So in bonds, you receive two things. That is your interest plus principal amount at the time of maturity. In bonds, we receive two things, interest and principal amount at the time of maturity. So with the help of these two things, we will value the true value of the bond. Okay. Now how to use this formula, I will tell you. So let's start this. A bond with a face value 1,000 carries a coupon rate of 10% per annum payable annually, what will be the annual interest payment? Here you need to calculate just interest payment. This one is the simple one. So everyone tell me your answer. Bond face value 1000. ठीक है, coupon rate equal to 10% per annum. So what is the annual interest payment? Very simple, 1000 into 10%, that is your rupees 100. This is your answer. Okay, this is how we calculate interest payment. Yes or no? Chali. Now let's calculate the value of the bond. Now I hope everyone understood it, how to calculate the interest. Okay. 5-year bond has a face value 1000 and pays 8% annual interest. If the market value of interest rate is 10%, what will be the bond's approximate price? Means what will be the true value of the bond? Okay, so let's start this solution. Now, for this 5-year bonds, for this 5-year bond, what is the face value? 1000. And what is the coupon rate? How much we are going to receive interest on this bonds if we purchase? That is 8% per annum. Okay. But as an investor, or if I say as a bond holder, I want 10%. Okay, this is the market rate of interest, or you can say in market, if I invest in other things, I can receive 10%. But for this specific bond, what is the interest rate I am receiving? 8%. So can you tell me the coupon amount now? Just use the previous question formula, 1000 into 8%. So 1000 into 8% is your 80. Yes, and for how many years you will receive? For 5 years. Means for first year also 80, second, third, fourth, fifth. Okay, for 5 years you will receive same 80, 80, 80, 80. Now, for the fifth, or you can say at the end, you will receive your principal amount also. And here you will receive 1000 only. Hana? Here you will receive 1000 only. If nothing mentioned, we are assuming whatever the face value is, the same amount we are going to receive at the end. So at the end, you will receive 1000. This is the interest amount. This is the principal amount. Okay, so this is about your bonds. Now as an investor, what is the interest rate I want from this bond? That is 10%. Okay, that is 10%. So this amounts, what I'm just now I have calculated, this belongs to future. Okay. Today is my 0 time period, and this amounts at 80, first, second, third, fourth, and fifth. This 80, 80, 80, 80, and 1000. This amounts are from future. Okay. I have not purchased this bond yet. I am just valuing whether to purchase it or not. Okay. So this is the amount I have calculated that I will earn if I purchase it. But I want to know today's value. But whatever amount I'm paying today, that is worthy or not. So what I will do, I will calculate the future values amount. Present value, today's value. Yes, I will calculate the future incomes to value in my today's value. Okay, for this valuation, for this conversion, I am going to use time value of money, and I will use present value. Okay, I will use this present value. So here luckily in question they are giving, use present value for rupee 1 for 5 years. Okay, means for 1 to 5 years, whatever income you are receiving, Okay, so this is just the hint they are given. Suppose if you receive 1 for 5 for 1 years, for 1 year, second year, third year, fourth year, fifth year, or if you earn 80 rupees for 5 years, use this 3.791. Okay, this is the present value, and present value I will calculate with the market value, that is 10%. And here they have mentioned it. So how to calculate the true value? Just use 80, your interest amount, multiply with the present value of 10% for 5 years, add redemption amount, maturity amount, with the multiply with the present value of 10% at the end of 5th year. Okay, so just take 80 yearly income, multiply with the present value factor, that is 3.791 plus 1000 into at 10% for 5 years, that is 0.621. Just multiply this and tell me the final answer now, everyone. 80 into 3.791, that is 303.28 plus 1000 into 0.621, that is 621 plus 303.28. So correct answer is 924.28. Answer. The true value is only 924, and you are paying 1000, means you are paying extra. Hana, you are paying extra. So this bond is overly priced. You will never purchase it. So this is how you need to calculate bonds value. Okay, chaliye. Let's solve one more question based on this unit only. So which of the following is a characteristic of zero coupon bond? They provide regular interest payment. No. Zero interest. Correct. They are issued at face value. No. They do not pay periodic interest but are redeemed at face value. Yes. They issue at discount, and at the time of maturity they are paying face value. So correct answer is your answer C. Then next, what is the key characteristic of equity financing? It creates legal obligation to repay with interest. Then it increases the company's debt burden. It involves giving up ownership and control. It has a fixed maturity date. Equity means when you are sharing ownership. Okay? So when you are sharing ownership, you will never receive any interest. This will never create burden as a equity, as a debt, as a loan. Yes, it has no fixed maturity date. Correct answer is it gives ownership and control in that company. So correct answer is your answer C. In case of liquidation, who gets paid first? Equity shareholder, preference shareholder, debenture holders and creditors, promoters of the company. See, suppose if I started my business, now I am not able to continue my business. What I will do, the first thing, I will pay to my creditors. Yes, I will pay first to bank loan. Correct? Before retaining my own amount, before giving to my preference shareholders or to my promoters, firstly I will pay to the outside parties, to the third parties. Okay? Like debenture holders, creditors, banks. So who will get first at the time of liquidation? Debenture holders and creditors. So first thing that we need to understand, that is foreign exchange. Yes, so if we see the definition says foreign exchange refers to exchanging the currency of one country for another at prevailing exchange rates. Here we are converting from one currency to next currency. Yes, that is what foreign exchange. Chaliye, so let's take one example. So here you can see we have here America, and one side we have our India. Correct. Now what we are doing, we are purchasing. Yes, we are purchasing goods. We are purchasing goods, correct, from America, and we are going to import. If we are purchasing from outside, this is your import. This is your import. I hope you know what is import and export. See, when you are purchasing from outside within India, this is import. On the other hand, if you are selling from India, okay, if you sell from India, then that is your export. Okay. We have these two terms, import and export. When you purchase from outside, that is import. When you sell outside, that is export. Now, in India, we are using which currency? Can you tell me which currency we are using in India? We are using INR. Yes, Indian rupees we are using. On the other hand, in America, they are using dollars. Yes, they are using dollars. Now, seller is from your America and buyer is from India. Yes, buyer earns in Indian rupees and seller, whatever business they are doing in dollars, in their own currency. Now, as a buyer, when we are purchasing from outside, yes, when we are purchasing from outside, we can we pay this INR to that seller? What do you think? That seller will accept INR? No. Why he will accept INR? Because in that country, there is no use of that INR. Yes, there is no value of that INR. So here, as a buyer, we need to convert this INR into dollars. And then only we will make the payment. Yes, so for making the payment in different currency, we require to convert our domestic currency into any foreign currency. This is your home currency, this is your domestic currency. Now, when you are converting into different currency, that is at that time you require foreign exchange rate. Yes, so that foreign exchange rate is required for converting from one currency to our other currencies. This is what foreign exchange means. I hope you got this. So again, let's read the definition. Foreign exchange refers to exchanging the currency of one country. Here we converted INR for another at prevailing exchange rate. For another means here we converted into dollars. Yes, we converted INR into dollars at prevailing exchange rates. Okay, so this is your foreign exchange means. And we have seen one example based on this. Now, coming to one more thing related to it, which is very useful when you are dealing in foreign exchange, that is rate. Correct. First, we understood what this foreign exchange means. Now, next important thing that we need to understand, that is rate. Yes, that is your rate. Now, while reading newspaper, while you are seeing any news channel, yes, there you might have seen this type of one statement, that is $1 equal to 87 rupees. Yes, or if you see today's rate for one United States dollar equals to 87.47 Indian rupees. Now this means what? Means if I want to purchase $1, I need to pay 87.47 Indian rupees. And every day this rate is changing based on market. Yes, so this changes based on demand and supply. So whenever you want to convert your Indian rupees into dollars, so how much and what rate we need to follow? That is your exchange rate. Yes, suppose I am saying I require $2. Suppose here if I say I want $2, can you tell me if $1 is equal to rupees 87.47? Okay, this is for your $1. So for $2, how much we are going to pay? Tell me, for $2, how much we are going to pay? Just multiply 87.47 into 2. That is rupees 174.94. Yes, so if I want to purchase $2, I require to pay 174.94. Or if I want $10 and $1 rate is 87.47. So I need to pay, or I require Indian rupees, that is 874.70. Yes, this much I required for purchasing $10. So whenever you are doing any transaction outside your domestic boundaries, at that time we require some different currencies. Even if you want to travel Dubai if you want to travel Malaysia, if you want to travel America, yes, you cannot use Indian dollars there. You need to convert it first, and whatever that currency, that countries they are using, we are going to convert in that particular currency. Yes, for that we require foreign exchange. So what two things we have understood till now? What is the meaning of foreign exchange and what is the meaning of this foreign exchange rate? Okay, I hope now you can read what this means. Yes, so for alternatively you can say we may pay 75, or sorry, this is your 87. This is your rupees 87 to buy $1. Okay, so this is your exchange rate. Now we have quotes under this foreign exchange rate. Sometimes we are going to see direct and sometimes indirect. Yes, but what is this direct and indirect? If we've understood the foreign exchange rate, then second thing we need to understand, that is direct and indirect quotes. Yes, first we have understood what is the meaning, then rate, yes, how to read that rate, and next thing we are going to talk about the quote. Chaliye, so let's start with this. So foreign exchange quotation can be either a direct quotation or an indirect quotation, depending upon the home currency of the person concerned. Yes, so generally what we see, $1 equal to rupees 75 means what? We may pay 75 to buy $1. Hana? $1 equal to 75 means what? For purchasing $1 we need to pay 75 rupees. Correct? So this is your direct quote. When you can see $1 equal to 75, this is your direct quote. Means is the home currency price of 1 unit of the foreign exchange currency. So direct quote means when you are using foreign currency 1 unit. When you are using foreign currency 1 unit, and based on that we are talking about our home currency, then that is direct quote. We all are in India. Yes, so if we are writing like 1 pounds, rupees 102, so this is your direct quote. Means we are talking as per foreign currency 1 unit. Okay? Based on the foreign currency 1 unit, we are talking about our own or domestic currency amount. That is your direct quote. That is your direct quote. Now, next is your indirect quote. Indirect quote is your reverse of your direct quote. Okay? So here when you are representing foreign currency price of 1 unit of the home currency. For Indians, home currency is your INR. Okay? Home currency is your INR. And apart from INR, all other currencies are foreign currency. Yes, so in direct quote, we are representing by taking 1 unit of foreign currency. But as per indirect quote, we are taking 1 unit of home currency. Means rupees 1 equal to dollars 0.0133. This is your indirect quote. Correct? Direct quote when you are representing in your foreign exchange, foreign currency 1 unit. Indirect quote means when you are representing 1 unit of your domestic currency or home currency. So this is about direct quote and indirect quote, and this is very important. In exam they can ask you direct question based on this. Yes. Then how to convert? What if they are giving you indirect quote and they are asking you about the direct quote, or if they are giving you direct quote and in exam they are asking about the indirect quote? So we can use this formula. We can use this formula. If they are asking for direct quote, use 1 divided by indirect quote. If they are asking about indirect quote, just do the vice versa of this formula. Correct? Chaliye. So let's start and solve 2 questions based on this topic. Okay. So if direct quote of $1 is equal to rupees 45, how can this exchange rate be presented under indirect quote? We need to convert this direct to indirect. Okay. So your direct quote is what? When you are representing 1 unit of foreign currency. So here $1 equal to rupees 45. Okay. Now, indirect quote means when you are representing one unit of your home currency or of your domestic currency. So here you will do 1 divided by indirect quote, that is your 1 divided by 45. So please calculate and tell me what is the amount here. 1 divided by 45. So this is your dollars 0.0222. Okay. So here your indirect quote is equal to 1 rupee equal to dollar 0.022 and 2. Always remember when you are reading foreign exchange, Hana, after decimal we are going to take 4 digits. Always remember when you are reading your forex, always take after decimal 4 digits. Okay, this is the assumption you need to take while solving a foreign exchange. Chali, so this is about your direct quote if you are converting into indirect quote. Coming to the next question. Everyone please try once. Let's see how many of you can solve this. So if indirect quote is dollars 0.025 per rupees, how can this exchange rate be shown under direct quote? So here we need to calculate. Okay. So here we have indirect quote. And that is US dollar per rupees. So 1 rupees equal to dollar 0.025. Yes, this is your indirect quote. So how you can get this into a direct quote? Please everyone try to solve it. So now we need to convert indirect quote into direct quote. Okay, we need to convert it into direct quote. So what you will do, 1 divided by your indirect quote, or you can say your dollars. So here 1 divided by 0.025. 1 divided by 0.025. So here your $1 is equal to rupees 40. And this is your answer. Okay, you need to just replace the amounts. So this is as per your direct quote and this is as per your indirect quote. Okay, this is as per your indirect quote. So here you need to write that is your direct quote. Yes, and here is your indirect quote. So this is how you need to solve in your exams also. And remember, this type of questions they are going to ask for conversion. Correct? Chali. So this is about direct and indirect quote. Now coming to important topic, that is again bid and ask. Now this is very important while getting your foreign exchange rate. Sometimes they are giving bid and ask also. But what is this? See, you must have seen this type of exchange rates. Yes. Or you must have seen like $1 equal to rupees. Suppose 85.76, 85.79. Yes, you must have seen this type of exchange rates. Correct? Like $1 equal to rupees 85.76 slash 85.79. So which rate we need to use and when to use which particular rate, and this rates are actually what? Yes. So remember one thing, this right side rate is your ask rate. This is your ask price. On the other hand, this 85.76 is your bid price. This is your bid price. Now, as a customer, whenever we are purchasing, whenever if you are purchasing any goods, you are purchasing at a high cost. Okay, you are paying more amount. But when you are selling the same goods, you are getting lesser amount. Okay, means what? See, suppose I am a shopkeeper. Okay, you want this calculator. I am saying I will give this calculator for 500 rupees. So you will pay me 500 rupees. Now after 1 month, you are saying, no, we don't want to use this calculator. Please purchase it back. So I will not purchase this calculator for 500 rupees. I will purchase this for 450 or 400. Yes. So always remember, as a customer, you are purchasing at a higher amount and you are getting lower amount. Suppose if you are purchasing jewelries, so you will purchase jewelries for a higher amount. But if you return the same jewelry after 1 day, 2 day also, you are going to receive lesser amount. Okay. So what we are doing with this particular foreign exchange then? How we are linking this thing? See, here, suppose if you want to purchase this $1. As a customer, if you want to travel, okay, and for that traveling you require $1. So for purchasing $1, you will pay which amount? Higher amount. You will pay higher amount. So this is your ask price. Okay, this is your ask price. Now after completing your travel, if you are coming again in India from abroad and you want to convert your dollars into Indian rupees, because that dollar is of no use in India. Yes, so you want to convert it into Indian rupees. So which rate you will use? At the time of purchasing that $1, you paid more amount. But after 1 month, if you are returning the same dollars, you will get lesser amount, and that is a bid price. That is a bid price. Okay, let's read the theory given here. So bid indicates the demand, while ask indicates the supply of a stock when you are purchasing. So here bid means, bid is a maximum price that a buyer is ready to pay for a specific product. Bid range is usually higher than the current market price. Bid rate is always lower than the ask rate. See, bid rate is always lower than the ask rate. Yes. Then ask is the maximum price that the seller is asking for a product. If you want to purchase $1, what is the maximum price you need to pay? Here, and ask price is always more than your bid price. Ask price will be lower than the current market price. Okay, so this is about bid and ask. Always remember your right side, yes, after slash, that is your ask price, and that side is always going to be higher amount. On the other hand, if you see your left side, that is going to be at a lower side, and that is your bid price. Okay, always how you can remember this? See, while reading alphabets, how we read? A, B, C, D, E. Yes, this is how we read alphabets. But in case of Forex, you start with B and A. Okay? Under the Forex, you are not reading A, B, C, D, E. No, you are reading in a reverse manner. B, A. B, A. Okay? Always in Forex, we are going to read in a reverse manner. B, A. First B will come and then A will come. Correct? Bid and ask. Chali, I hope you can use this trick for remembering this formula. So let's solve questions based on this. A bank quotes USD INR as 83.20 / 83.60. What does 83.20 represent? They are asking about this. Here, ask rate, forward rate, bid rate or spot rate. So just now we have seen what is ask rate and bid rate. So there is no relevance related to forward rate or spot rate. Okay, so tell me, what this 83.20 represents? I told you that trick now. We read alphabets in a reverse order, B, A. So this is your bid and this is your ask. Correct? So correct answer is answer C. Coming to the next one. In Forex, the difference between the ask rate and bid rate is called spread, margin, premium, discount. See, if I talk about bank receives, bank deposits, yes, bank takes deposits and bank gives loans, yes. So here, whatever bank they're paying on deposit, that is, suppose 6%, and whatever amount they're getting from loans, that is around 14%. है ना? Interest from loan is going to be higher than whatever they are paying on deposit. And the difference, and the 14 minus 6, that is your 8%. That difference is what for bank? This difference is going to be income from income for bank. Yes, the same thing under spread when they are getting the difference. They are getting the difference from the bid and ask. When they are subtracting bid and ask, the difference is known as spread. Okay, that difference is known as spread, not margin, premium or discount. Correct answer is your answer A. Okay, now let's see the next topic in a very quick manner. So next is your value date. Now we have different types of value dates. So I will explain this one with the help of this chart. Okay, so basically we have 4 concepts. First, cash ready. Second, term. C, spot. And D, forward rate. Cash or ready means if your transaction you are doing on 24th April 24 and you are making a deal on the same date, if you are entering transaction on the same date of that transaction, you are making a deal on that same date only, then that is known as cash or ready. That is known as cash, or you can say ready. But if you are dealing in a transaction on 24th April, but the deal you are getting into that is on 25th, means next day. Yes, tomorrow. So that is term. Tomorrow you are going to enter in that deal. That is term. So that is B1. Spot means after tomorrow. Okay, day after tomorrow when you are entering into a transaction, means your date of transaction is same 24th April, but you are going or making a deal on 26th, then that is your spot rate. That is your spot. And after 26th, okay, after this 26th, if you are entering into deal, then that is forward rate. Cash and ready, same day. Term means tomorrow. Okay, after day after tomorrow, that is spot. And day after tomorrow, after spot, or you can say you are going to use forward rate. See, okay, so these are the 4 important terms under this forex. Now, I think we need to understand that as a business, when we are going to use this thing, yes, capital means your funds. Yes, understand one thing here, capital means your funds. So what structure we want to create for our funds? Yes, now if I say that if we are starting any funds, correct, so you require money for what? You require money to purchase all this long-term assets, yes, like non-current assets like building, machinery, yes, plant, equipments. You will purchase all these things to use for long term, yes, to use for more than 12 months. On the other hand, whatever business you are starting, so for that you are purchasing raw materials, finished goods, you are preparing and you are selling to your customers. Along with that we have cash. So all these things are your current assets. But for doing for this operational activities, yes, like manufacturing, selling, yes, or purchasing your long-term assets, we require funds. We require funds. Without funds, you cannot purchase, you cannot manage your business. Yes, so ultimate thing for our business is what? That is your funds. Now, how you can arrange this funds? Suppose if I'm starting my business, so first thing what I will do, I will see how much money I have. Okay, first I will use my own saving. Yes, I will use my own saving. Then afterwards, I will ask to my family members if they contribute in my business or not. After that, what I will think, I can take a bank loan also. Yes, I can take bank loan. I can ask to my friends also. Yes, so all are the ways to which I can arrange the funds. Yes, but there is 2 things in our business as a funds that we need to understand. Your fund which your owner is giving to your business, or that is loan part. Okay, so majority of the times your funds are divided into these 2 parts. Yes, so funds are divided into these 2 parts, that is your owner fund or loan amount. These are the 2 ways. Okay, when I'm using my own source, that is my owner's fund. Yes, or if I'm sharing my company's ownership, or whatever members are contributing to get that membership, that is also they are going to be known as owners. So one is your owner's fund and one is your loan amount. Okay, loan amount means when I'm borrowing from my friends, family, or if I'm borrowing from any particular bank or this NBFCs or any party. Okay, so that is loan amount. So we call this owner fund as your equity. Means when you share ownership, that time we call it as equity. On the other hand, when we're talking about loan, means when we're talking about debt. Yes, so whatever borrowings you have done, that is your debt amount. So funds are going to be part of two things, equity and debt. Okay, equity is when you are sharing ownership, debt when you are borrowing from someone. So this is how you can arrange funds for your business. Yes, now in this we need to understand capital means what. Capital means funds. Yes, and how you can arrange these funds. Just now we have seen two sources. Source number one, you can use your own funds, that is your equity, or you can borrow, that is your debt. Yes, you can borrow, you can do the borrowing, that is your debt. So here funds are of two types, equity and debt. Okay, but in what amount we are going to bring your debt amount or equity amount, that we need to understand. So what is this capital structure? See, let me give you one example here. Suppose here is your Reliance company and here is your XYZ company. Okay, now in Reliance company they are saying the equity portion, okay, total is your 100% always. Now in this Reliance company, equity portion means Ambani's, they are the owners, yes, they are the founders, so they have contributed in this Reliance industry, suppose 70%, and debt they have taken, that is 30%. Debt means borrowing, okay, they have done only 30%. On the other hand, if I talk about XYZ company, in this company the equity is only 40% and debt from different sources they have taken 60%. Yes, means what? Suppose a total fund both the company requires, that is suppose 10 lakhs. Okay, both company wants 10 lakhs. So how Reliance company arranged this? 7 lakhs Ambani's invested and 3 lakhs they have borrowed. On the other hand, if I talk about this for XYZ business, so owners contributed only 4 lakhs and they have borrowed 6 lakhs from outside. That is debt amount. Now, after seeing these two companies, Reliance and XYZ company, now my question is, which company is going to be in a higher risk? If I ask you to invest, okay, in which company you will never going to invest? Tell me, Reliance or XYZ? See, I know Reliance is a famous company. We know their past, but we don't know about the XYZ. I'm not asking from that point of view. I'm asking based on this investment. Ambani's are investing 70% and debt they are taking 30%. On the other hand, XYZ. Acha, leave XYZ. Let's take Tata. Okay, now you know Tata company. Okay, now you know both companies past. But now I'm asking, in which company you are going to invest? Just think and tell me the answer based on this equity and debt. As a banker, to whom you will sanction loan first? If both are in a equal net worth, yes, both are doing the same work, then which company you are going to issue first loan? Of course, they Reliance, because risk is less. Now, why risk is less? Because the majority of the amount is invested by their owners. Yes, so here the risk is less compared to your company, Tata. Yes, so the chances of investment is going to be with Reliance Industry. So this structure, this debt and equity, this is the structure. Structure is what? Owner, or you can say equity contribution is 70%, debt is equal to 30%. This is the structure. This is structure of Reliance Industry. Okay, and now can you tell me what is the structure of XYZ company? The structure is owner's fund is 40% and debt is 60%. This is the structure. Okay, that in a company, how much we have borrowed and how much we have invested as a owner. So this is what structure is. Correct? So the long-term money required by the firm is known as the capital. Check the funds. Capital structure referred to as the proportion of debt, equity in the total long-term funds raised by the firm. If I talk about Reliance Industry, okay, if I talk about Reliance Business, so how much they have raised to the debt, that is 30%, and how much to the equity, that is 70%. Okay, that is 70%. So here the long-term money can be from two sources. Just now we have seen, again we are repeating, from equity, money of the owners, or debt. Debt is what? That is borrowing. Okay, so this is about your capital structure and that meaning. Now let's solve an illustration based on this. A firm starts its business by raising total long-term fund 500 lakh to meet its requirement. Equity capital 200 lakh, debt capital 300 lakh. So here we want to start in business, and what we have decided, the total fund we want 500. Yes, this is the total fund we want. Now how I will arrange this fund? I will take the owner's amount, that is equal to 200, and I will take debt amount, that is equal to 300. Yes, and if I add this, this is my total fund. Now here, if I want to know the proportion, if I want to know the proportion of each funds, yes, if I want to know the proportion of funds, how I will do it? I will take, suppose first equity. So I will take equity amount divided by 500. Yes, equity portion divided by total fund into 100. So can you tell me the answer? What is the proportion of equity here? 200 divided by 500 into 100. So this is your 40%. This is your 40%. Now can you tell me what is the proportion of debt? Again, do the same thing, 300 divided by 500 into 100. So that is 300 divided by 500 into 100. This is a 60%. Yes, so this is how we calculate proportion. Okay, this is how we calculate proportion. Or you can also go with this. If you want to know about, suppose, equity, okay, equity proportion, you can subtract 1 minus D. Suppose let's take, only 1 is your total. Okay, 1 means this is your total. So 1 minus, what is your percentage? You can write 60% or 0.60. Yes, you can write 100 minus D percentage or 1 minus 0.60. So this is 0.40 or this is your 40% if I represent in percentage. So this is how I can also calculate equity proportion. Same, I can calculate debt proportion. 1 minus equity. So 1 minus, if I see equity side only, 0.40. So your equity is, debt is 0.60. Or you can say this is your 60%. Yes, this is your answer. In case they're asking debt proportion, I'm giving only equity side, and if they're asking equity proportion, only giving debt amount. Okay, and if they're asking proportion for both the things, then you need to use this left side calculation. Okay, chali. So here we have understood about the capital structure and how to calculate the proportion based on that structure. Now we have one more small topic, that is leverage, gearing. So in the capital structure of a firm, if the ratio of the debt capital is high, it's called highly leveraged or high geared firm. Means what? If you're taking more borrowing amount than your equity amount, then your firm is known as high leveraged geared firm. On the other hand, if the ratio of the debt capital is low, it is called a low leveraged or low geared firm. Okay, so this is what about leverage. If you're borrowing more, then you are going to be known as high leverage firm. Acha, let's solve one question here. Let's see how many of you understood this part. Again, I am taking the same example. This is your Reliance and this is your Tata. Okay, why I'm taking again and again the same example? Because in exam they can ask questions based on analytical perspective also. Okay, so that's why we need to understand what the concept is. practically also as well as theoretically also. So just now we have covered your theory part. Now let's apply it. So if I say this is your equity, now you know what is equity, yes? And if this is your debt, you know what is debt? Debt is your borrowing amount. Equity is what? Equity is your owner's amount. So suppose in your Reliance industry, equity is your 80% and debt is your 20%. Okay, on the other hand, if I'm tell you about Tata, equity is around 70, sorry, equity in under Tata, that is around 35% and debt is around remaining that is 65%. So now my question is, which is going to have high leveraged or geared firm? Tell me. Reliance or Tata? High leveraged or highly geared firm means in which you have high borrowing amount, है ना? High debt capital means high borrowing amount. So which company is having high borrowing amount? Reliance or Tata? Correct answer is your Tata. Okay, so Tata is known as highly leveraged firm, whereas Reliance is known as low leveraged firm. Correct? So this is one small topic based on your leverage and gear. Now we have one more small topic. These are very important from exam perspective. That's why I'm completing subtopics. Now coming to the next important topic, that is weighted average cost of capital, known as WACC. Yes. So here just now we have understood the meaning of capital. Capital means your funds. Okay. How you can arrange this funds? Equity plus debt. Okay. Now for arranging these funds, I need to incur some cost. Yes. Like for issuing equity, yes, I need to pay dividend on that. I need to incur issuance cost. Yes. So all this is what cost for company. Cost for company. Whereas if I am taking a debt, I need to pay some fees. Yes, processing fees. All these things. All these things are again what cost for a company for taking a loan, for taking a debt. So if I want to know what is the total cost I incurred for taking funds, if I want to know what is the total cost I need to incur for taking total funds, then I am going to use this topic, that is WACC. But can I just go and directly add it? The answer is no. You cannot take direct addition. For this particular purpose, for knowing the cost of capital, we need to go with the average. We need to take weighted average. We need to give weights and then we are going to calculate. Okay, so WACC is what? Used to determine the cost of each part of the company's capital structure. And generally we have seen just now proportion of equity and debt. Okay. Now, it represents the rate of return that a company must pay for all of its financial sources such as debt and equity. So, your formula that you need to use for calculating WACC is proportion of debt. Just now you have seen proportion of debt. Yes, you will calculate in percentage. And if tax rate is given, if tax rate is given, subtract 1 minus T. If not, then ignore. Okay, then just ignore it. And cost of debt, again they are going to give you in your question if they're asking WACC. Otherwise, again we are going to learn how to calculate cost of debt in this unit only, but not in today's session. You need to add, okay, after giving the weighted weights, you will add to the cost of equity into proportion of equity. Proportion of equity, just now you understood how to calculate this proportion of equity. Okay. So here you will take that proportion in percentage and the cost of equity. Again, they are going to give you in questions. Otherwise, we have again 4 to 5 formulas for calculating cost of equity. Again, I am not covering that part in today's session. Chali. So let's start and use this formula. A company has the following capital structure. If equity is 60 lakhs, cost of equity is 12%, debt 40 lakhs, cost of debt 10%, tax rate is 30%. Now, first, let me write you the formula. Cost of debt into proportion of debt plus cost of equity into proportion of equity. Okay, so let's calculate first about the proportion. How to calculate proportion? First step is calculate total funds. What is your total funds? Add your equity plus debt amount. So 60 plus 40. So this is going to be your 1, 2, 3, 0, 0, 0 and 0, 1. Yes, this is your total. 1 crore is your total funds. Now, second thing, let's calculate the proportion of equity. So 60 lakhs divided by 1 crore into 100. 60 lakhs divided by 1 crore into 100. That is a 60%. Yes. And for the third, that is proportion of debt. 40 lakhs divided by 1 crore equal to 40%. Now let's put the figure, because already we know the cost of debt, that is 10% into proportion of debt, how much? That is 40%. But remember here tax rate is given, so 1 minus 0.30 plus cost of equity, that is 12%, into your proportion of equity, that is 60%. So if you solve the first bracket, 0.7 into 0.4, yes, just wait. So solve the bracket first. 0.7 into 40% into 10%, then 60% into 12%. So your total WACC is going to be 7.48%. Please everyone cross check it. Once this up to this point we are correct. Just cross check the answer once. Okay. So this is your WACC, and this is how we need to calculate. Okay. Now one question is homework for you. Just remember here we have the preference shares. This is one of the again way through which you can borrow the amount. Okay, so this is your homework question. Just I am giving you the formula. You just need to put the amounts. Cost of debt into proportion of debt plus cost of preference shares into proportion of preference shares plus cost of equity into proportion of equity. Okay, use the same way for calculating the proportions. Okay, just remember you have one extra thing, so you need to add that part. So total funds here you are going to take, that is 20 lakhs plus 10 lakhs plus 30 lakhs. Yes, so 50, 60, 60 lakhs. Now I hope you can calculate, and this is your homework question. Everyone try this and share your answer through the comments. Okay, now one more thing, that see, decision means what? When you need to select any one alternative. Yes, like after clearing 10th standard, you got the option to go with the science stream, to go with the commerce stream, to go with the art stream. Yes, so you opted suppose science stream. So that is the decision you have made. Correct? So this is the meaning of decision. But in your AFM, we are talking about investment decision. Means what? Suppose if I am holding rupees 1 lakh, Now, with this 1 lakh, whether should I purchase jewelry? Yes. Or should I purchase some shares? Or invest in FD? Or go with the mutual funds? Now, I will evaluate different options where I can invest this 1 lakhs. Yes. And when I'm evaluating what things I'm going to search, I will search what returns I will receive. Yes, what returns I will receive and which of the options are, less risky as well. Options which are having less risk. So suppose if I'm saying if you go with the jewelry, the risk is suppose 10% and the return is just 5%. Shares, I can say you are going to receive suppose 16% return, but risk is suppose 20%. With the FD, you are earning suppose just 7%. On the other hand, there is zero risk. Mutual funds, you are going to receive this return suppose 15%, but risk is suppose 7%. Yes, I have evaluated this different options. Now, after analyzing each options, I can say mutual funds is your best option. Hana, in this you are receiving good return as well as minimum risk we have. So what as an investor we will do? See, FDs, that 7% is very minimum amount. The inflation rate is around 6 point something. Yes, so I'm not going to earn anything. Whatever I'm earning, that is equal to inflation price. Yes, so what I will say, FD is okay, but if I go with the mutual funds, I am earning a good amount of return. Even I have to I have to face some risk, but that is very minimum compared to remaining options. So when I'm going with the mutual funds, then let's invest my 1 lakh rupees in this mutual funds, then that is the investment decision I have made. Yes, this is the investment decision I have made. So what is investment decision? It refers to selecting the best options by evaluating and analyzing for the business. Like from this options, I have selected mutual funds. Correct? This is the best option by evaluating, by analyzing return as well as understanding the risk. By analyzing these things, I have evaluated and analyzed for the business. Correct? Same concept as an individual, what we are doing, what we are calculating, the same thing businesses are doing. Okay, so this is what investment decision. Now let's talk about from the business point of view. Suppose here is a company and the company wants to invest rupees 10 crores. Now what they will do, they will identify the projects. What are the projects? What are the options they have? Suppose in your first project, they want to manufacture car electronic vehicle. Yes, they can start this electronic vehicle manufacturing. Now in your second project, they evaluated that they can start this solar panels. Okay, so these are the two options which this company identified. Now, in both the companies, if they talk about the investment amount is 10 crores only. If they go with the project A, 10 crores they will invest. If they go with the project B, they will invest 10 crores. Now, what they will do? They will identify the return. What they will search, the next thing, they will start analyzing, evaluating. So, the first thing they will talk about the return. If they start this electronic vehicle, what return they can earn? Here, they can earn, suppose, 45%. This is the return amount. If they go with the solar panels, they can earn, suppose here, 27%. Okay. Now, next thing they will talk about, that is risk. So here, suppose risk, if they go with the electronic manufacturing of the cars, their risk is suppose 9%. And if they go with the solar panels, their risk is suppose 13%. So this is the analysis they are going to do. Now, after understanding that, okay, if they go with the car electronic vehicle, their return is high as well as risk is low. Return is high, risk is low. But if they are going with the project B, that's solar panels, their risk is 13% and their return is also 20%. So as a rational investor or as a management, what I'm going to select? Of course, project A. So when I'm going with the project A, that is what decision I have made. Yes, what future return I am going to earn, what risk I am going to face. So if I am calculating through this kind of, analysis, evaluations, then that is what investment decision. So this is your investment decision, correct? I hope everyone understood what is the concept, what is the meaning of investment decision. Now, after that, let's talk about the methods. Okay, we have methods of investment appraisal. For calculating this investment decision, for making that investment decisions, we have major two sides. First one, when you can use non-discounted methods. Next side, discounted methods. If you divide the major part of this investment decision, you have two sides. First, non-discounted methods. Next, discounted methods. Now, what is this discounted methods? Leave for some time. Yes, let's talk about non-discounted methods. Under this, you have two methods. Number one, that is your payback period. Second one is your accounting rate of return, ARR. Payback period method and accounting rate of return. These are the two methods covered under non-discounted methods. So let's start with the first one, that is payback period. Payback period is a very simple method. Now, as per this method, if I take with example only. Okay, so let's start with one example. Suppose today I purchase one car for 5 lakhs. I purchase one car for 5 lakhs and now I'm going to use this car for rental purpose. For rental purpose, and every year I'm going to generate from this car, suppose 2 lakhs. Not 2 lakhs, for a time being, let's say every year I'm going to generate 1 lakhs. From rental, I can generate yearly, per year, 1 lakh as my rental income. Again, I am repeating this example. If I purchase one car by investing 5 lakhs and after purchasing, I am going to use this car for rental purpose. So I will earn the rental income, that is 1 lakh per year. So my question is that if you earn 1 lakh per year, in how many years you can recover this 5 lakhs? Tell me. In how many years you can recover your invested amount? Okay, so let's see. 1, 2, 3, 4, 5. Okay, so first year also 1 lakh I'm going to earn, second year also 1 lakh, third year also 1 lakh, fourth year also 1 lakh, fifth year also 1 lakh. Means I will get this 5 lakh return after 5 years. Hai 1 lakh, 1 lakh, 1 lakh, 1 lakh means within my 5 years, I will recover my invested amount. And this is what your payback period means. Payback means whatever you have invested, in how many years you will get it back. Yes, that is what payback. And what is the time period? That is 5 years. So what is the payback period here? Within how many years you can recover your invested amount. That is your payback period method. Now let's read this. So payback period is the period at the end of which the initial investment is entirely returned to the investor. So as per this example, I'm going to recover, yes, as per this example, I'm going to return, I will get the payback period as 5 years. Correct? So this is how we are going to calculate. Payback period means the simple calculation, what we are always doing. In how many years we are going to recover it? Just by adding. Yes, whatever the future incomes we are analyzing, we are just going to add it. The same thing payback period talks about. Now, it is to be remembered that both the positive or negative cash flows are to be added till the total net cash flow equals the amount of the initial investment. So what is the formula here? Payback period method equal to amount to be initially invested divided by estimated annual net cash inflow per year. So here if I use this formula, amount to be initially invested, that is what? 1 lakh or 5 lakhs? What is your investment amount? 5 lakhs. 5 lakhs. Divided by estimated annual net cash flow per year. Every year, what is your annual return? Yes, that is 1 lakh divided by 1 lakh. So here your answer is 5 years. Yes, this is your payback period. And as soon as you calculate this period, you will stop calculating. Yes, this is a very simple method, and if in exam they're asking this type of questions, I know you are going to tackle it. Yes, so let's start with a question. Let's practice. A company plans to invest 8 lakhs in a project. The project is expected to generate a constant annual cash inflow of 2 lakhs. Calculate the payback period. Payback period equal to, here, your initial investment divided by estimated annual cash inflow. Initial investment is your 8 lakhs divided by 2 lakhs. So your answer is 4 years. This is your payback period. I hope everyone got this answer. Okay. Now, so this is the one method we have completed from non-discounted methods. Non-discounted methods, we have 2 methods. So we have completed this first one. That is your payback period method. Now let's talk about your discounted methods, and we have 2 methods again under this. That is your net present value, and the next one is your internal rate of return. These are the 2 methods which we are going to cover under the discounted methods. But what is the meaning of discounting? Yes, what is the meaning of this discounted here? So first, let's talk about this. What is the meaning of this discounted word? So discounting means this is the discounted cash flow, DCF, is a valuation method. This is a valuation method that estimates the value of an investment using its expected future cash flow. And as an analyst, we are going to use DCF to determine the value of an investment today based on projections of how much money that investment will generate in the future. That is what discounted cash flow. So now if I take one example, and if I discuss this discounted cash flow, means if this is a 0 time period, okay, this is your this is your 0th time period, correct? Now at this 0 time period, suppose I am investing rupees 4 lakhs. Correct? At this 0 time period, I am investing rupees 4 lakhs. Now, this is my first year. This is my second year, third year, fourth year, fifth year, sixth year. Correct. After investing 4 lakhs, yearly, if I check, every year, suppose first year, if I am generating now, let's talk about income. Okay. First year, suppose I am generating 70,000. Second year, I am going to generate 80,000. Third year, I am going to generate, suppose, 90,000. Fourth year, 1 lakh. Second year, 1 lakh 20. Third year, sixth year, I am going to generate 1 lakh 50. Okay. If I am using non-discounted method, means if I am using, suppose, payback period method, what you will do, you will just add all these cash flows. You will add all these cash flows till you recover your 4 lakhs. This is a normal calculation. As a layman, we always do. Okay, as a layman, we always try to add our future incomes, and by that we always say the answer. But when you are actually working as a financial analyst, or when you are working, or when you are reading finances, yes, so here we know one thing, that there is one term known as inflation. There is one term known as inflation, because of which prices are increasing. Correct? The same, if you're purchasing today one Parle G packet, you're paying rupees, that same 10 rupees, but that quantity that has been reduced. Correct? That same Parle G, if you would have purchased in a 2000 year, then at that time, by paying 10 rupees, at that time you could have received 10 biscuits in that packet. So that is the change. Though you are paying the same thing, but are you getting the same value today? No. Yes, the value is decreasing, or the price is increasing. Both the points you can say. है ना? By paying the same amount, we are getting lesser quantity. So why this actually happens? Because of time value of money, because of inflation. Your prices are increasing day by day. So as a financial analyst, when we are talking about finances, we are always going to adjust all our future incomes based on this time value of money. Based on this, discounting, inflation, we are going to adjust our future incomes. Here you can say 70, 80, 90, 1 lakh, 120, 150. All this incomes, all these are future incomes, and these are not adjusted based on inflation part. So first, what I need to do, I need to convert this. I need to adjust all these future incomes based on inflation. Correct? And for that adjustment of that inflation, I'm going to use for this inflation adjustment time value of money. Means whatever money you are receiving today, that is not going to equal after 1 year or tomorrow also. Okay? So here we are going to use this time value of money to adjust this inflation. And for this adjustment, we use discounting. We use here discounting. Correct? Discounting. Means if I want to know what is the value at a 0 time period of all your future incomes, I will do discounting. Okay, so if yes, this is a 0 time period, and if I want to know today's value, yes, at a 0 time period, if I want to know the value, so what I will do, I will value the first year's income and I will discount it. I will bring it back by discounting by 1 year. So what is the formula of this discounting? Discounting formula, or you can say the present value formula. Under this discounting, we have two sides. One is your present value and one is your future value. Okay. So if you want to know after 10 years, after 12 years, the true value, that time you will use future value. But if you want to know the after adjustment of inflation part, what is the today's value at your 0 time period, that time you use this present value. And the formula for this present value is whatever the cash flow you are generating divided by 1 plus r to the power n. 1 plus r to the power n. This is the formula we need to use. So whatever income you are generating in your first year, that is 70,000 divided by 1 plus whatever the rate they are providing, every time they will provide in question. Power 1, because 1 year you are going to bring it back. Okay? Same for the 80,000. 80,000 divided by 1 plus whatever r they are going to give, power 2, because 2 times you are going to bring it back. Yes, for the 4th year, suppose 1 lakh divided by 1 plus r to the power 4, because 4 times you are going to bring back, because we are going to calculate at a 0 time period. Yes, now if I want to calculate for the 6th year, can you tell me? You will divide by 1 plus r power 6, because 1, 2, 3, 4, 5, 6. 6 times you are going to bring it back. So this is how you are going to use the power. And this is your discounted cash flow, correct, for when you are adjusting the inflation part. Now the first thing under this discounted cash flow is your net present value. Net present value. Now net present value means a rupee now is more valuable than the same rupee a year later. Now net present value used in terms of cash flow means the present value of all future cash flows. So basically here when we are talking about NPV, that is saying whatever sum of all future incomes present value minus, yes, sum of all future incomes present value minus your initial amount. Correct, your initial amount. And if here you get yes, more amount for your sum of your future income, you will accept the project. But if you are saying the amount you have invested today, that is more than the amount you are receiving, then you are going to do what? You are going to reject that product. accept, reject, accept, reject. Yes, so this is how we need to calculate time value of money. So net present value formula is what? Present value of net cash inflow minus total net investment amount. And if your NPV is more than or equal to 0, accept the project. NPV is less than 0, then reject the project. Now, let's solve one question based on this concept. So compute the NPV for a project with a net initial investment 1 lakh and the net cash flow for year 1 is 55, 80 and third year 15,000. Now what they are saying that we are going with one project. This is a 0 time period, first year, second year and this is a third year. In a 0 time period you are investing 1 lakh rupees. Here this is your invested amount. This is your invested amount. Now in your first year you are going to generate 55,000 as your income. Okay, and in your second year you are going to generate 80,000 as in your income. Third year 15,000 as your income. Now we want NPV. So first what we are going to do, first we are going to calculate all these future values, their present value, because all these are future incomes and first we need to adjust it by inflation. So how I will adjust this 55,000 to bring it at your 0 time period? 55,000 divided by, now R is your 10%. R is your 10%. So what is the formula? Cash flow divided by 1 plus R to the power N. 55,000 divided by 1.10 to the power 1. Because once only we need to bring it back. Now let's calculate for 80,000. So 80,000 divided by 1.10 to the power 2. For the third year, yes, what is your amount? 15,000. This is a 15,000 divided by 1.10 to the power 3. 3 times we need to bring it back. So let's calculate your present value of future inflows. So for the first year, what you will do? Just type 50,000. How you divide? How you divide? Suppose if I say divide 10 divided by 2. How you will do this? Just write 10 divided by 2 and you will press equal to button and you will say answer is 5. Correct? Again, if I say divide 25 divided by 5. How you will do with the calculator? Everyone please do with the calculator. How you will do it? 25 divided by 5. Correct? I hope you know how to calculate with your calculator the basic division. Okay. So if you know this one, if you know how to calculate with your calculator, then let's come to this part. Okay. Now let's come to this part. What is the numerator here? That is 55,000. And what is the dividing figure? Denominator 1.10. 55,000 divided by 1.10. Yes, this is what we generally do, divided by 1.10. And when your power is 1, just press once equal to button. Just press once equal to button. Means for the 0 time period, if you bring this 55,000 1 year back, today's value is 50,000 only. Today's value is 50,000 only. You know what is the difference in case of power and in your basic calculation? Only the difference is your power. Yes, only the difference here is your power. Whatever power they are giving, yes, whatever power they are giving, just press for that power calculation equal to button, that is same time whatever the number they are mentioning as a power. Okay, means what? See, 80,000 divided by 1.10. What is your power? 2. So press your equal to button for 2 times. 1, 2. So your value, that is 66,115. Now, for the third one, 15,000 divided by 1.10. Now what is your power? 3. So how many times you will press this equal to button? 1, 2, 3. Your answer is 11269. 11269. So what is the total present value of future cash flows? 55,000 plus 66,115 plus 1126,9. 127,384. Means today you are investing 1 lakh and by this 1 lakh you are generating 127,384. This is the income amount. So what is your NPV here? 127,384 minus 1 lakh. So your answer is 27,384. This is your answer. And this is how we need to solve your NPV questions. Okay? Now remember one thing, for more questions, for more better understanding, you can join my, that is the meaning of lease. You must have heard that we can purchase the goods or you can take the goods on rent. Yes? So when you are taking goods on rent, are you getting any ownership? The answer is no. You are only getting the right to use it. Yes? As per your agreement. And that agreement will tell you in how many years you need to return it or you need to vacate that area. So there is your rent agreement. The same concept we need to apply in your leasing, in your lease. So lease means what? Here, a lease is a contract. A lease is a contract under which one party agrees to allow use of its property to another party for a specific period of time on agreed payment terms. For example, let's take one more example. If I want one flat, yes, I want one flat and this flat is available for suppose 15,000. Correct? Now, here one flat is available and this is the building known as ABC building. Here one flat is there and I like that flat. So if I am taking that flat on a rental basis, what I need to do? This building belongs to this ABC person. Yes, Mr. ABC person. And he is the owner. But I want, yes, to take that flat on a rental purpose. So here, on a monthly basis, I will pay rent. Then only he will allow me to use it. Yes or no? So here, this situation that I'm creating, that is your lease situation. When you are not purchasing it, you are not the owner, but you are getting the right to use that asset, to use that property. The same thing we are doing under lease. So here, lease is a contract under which one party agrees to allow use of its property to another party. So here one party who is agreeing is your Mr. A, B, C. Yes, and that person is allowing me to use this building. Yes, to use this flat. And another party here is CA Aarti. Yes, because he is giving me this flat on a rental purpose. And suppose I want this flat for 2 years. Correct? Specific period of time on agreed payment terms. What agreed payment terms? Rupees 15,000 per month. Okay, so this is the definition of lease. Now under lease, we have 3 important terms. Generally, you know it, Mr. ABC is known as landlord. Yes, and whatever payments I'm making, that is my rental payment. Yes, that is my rent. So in your lease, we have some specific terms that we need to use. You cannot use landlord. You cannot use owner. Yes, you cannot use rent payment. We need to use that specific term. Now let's talk about those specific terms. So first one that we are going to talk, that is your lessor. Next, lessee. And the last one, the third term, which is important for you, that is lease rental. These are the 3 important terms that you need to remember when you are reading lease. And in exam, they ask direct questions based on these 3 terms also. They can ask definition. They can ask this specific terms. So now let's talk about each of this term. So first one is your lesser. Yes, let's talk about the first one, that is your lesser. Here, lesser is the one, the property which owns the, the party which owns the property. As per this example, who is the owner of this property, of this building? I'm the owner or Mr. ABC? Mr. ABC. Yes, so here your Mr. ABC is known as lesser. Here Mr. ABC is going to be known as lesser. Now, let's see the next term, that is lessee. The party which gets right to use the asset. Now, who is getting the right? I am getting the right, or Mr. ABC is getting the right to use that flat? We have understood ABC, he is the owner and he is giving me right to use that flat. Yes, so I am getting the right to use it. So here CA Aarti is your lessee. Yes, I'm going to be here lessee. And every month I need to pay 15,000. Yes, so that payment, that rent amount is known as lease rental. Agreed payment for the right to use the property, that is this rental income, that is rental, or you can say lease rental, rupees 15,000. Okay, these are the important terms, you need to remember it. Let's take one more example, and now it's your turn, and you need to tell me who is here lesser, who is here lessee, and what is your rental income or rental or lease payment. Okay, let's take one more example. Here is Mr. Amitabh Bachchan. Okay, he owns one property near that Juhu beach, correct? He owns one house near that Juhu beach. Now, I want, yes, here is your CRT. Now, I want this Juhu Beach bungalow on rent. Yes, so Mr. Amitabh Bachchan, he is the owner of that, but I want that bungalow on rent. So he said, of course, you can take this, and the payment you need to make if you are using it, that is rupees, suppose 10,000. Correct? Now, it's your turn. You need to tell me who is lesser here. Lesser. Mr. Amitabh, 10,000 or CRT? Tell me, who is lesser here? Very good. Mr. Amitabh. Yes, Mr. Amitabh. So, as per lesser definition, who is going to be lesser? Who owns it. Yes, or controls it. Yes, owns the property, controls the property. Who is lessee here? Who is getting the right to use that house? CART. So who is going to be here lessee? I am going to be here lessee. Yes, because I am receiving right to use. And lease rental, that is 10,000. This is lease rental. Okay, so these are the important terms which you need to remember under lease. So let's see the next topic, that what are the features of a lease. Again, first thing, that is, it is a legal binding contract containing the terms on which one party agrees to allow use of its property by another party. Now, when I want that Juhu Beach bungalow on rental purpose, here we will create one, written document, written agreement we will create. And as per that agreement, we will be getting legal binding contract. Yes, this is the proof if anything happens, against that contract. any person can sue. Mr. Amitabh ji can sue me if anything is against that, agreement. Even I can sue him if anything goes against that agreement. So here the proof is your that lease agreement, that those papers. Okay, now next. It guarantees the lessee use of the property and guarantees the lessor regular payments. So here two things are happening. First, Mr. Amitabh will get every month 10,000 rupees as that rental income, lease rentals. On the other hand, every month I am receiving the right to use that property. Correct? So that is the second thing. A lease can be residential lease, like I am taking just now, which is normally same for all tenants, or commercial lease, which is often various types. We will see what commercial lease is and what are the different leases. Then last is breaking a lease contract involves legal consequences, because here it is creating a legal bounding on both the parties. So these are the features of a contract, of a lease. Next, types of leases. So we have basically two major bifurcation, you can say here. The first one is your accounting lease and the next one is your commercial lease. So how we bifurcate this types of leases? A, accounting leases. B, commercial leases. Now, accounting leases, under this again you have two types, that is operating lease and finance lease. If we talk about commercial leases, we have leveraged lease, domestic lease, international lease, cancelable lease, non-cancelable lease, and sale and leaseback transaction. So these are the types of leases. So let's start with the first one, that is this one. We are starting with commercial leases. Okay, we are not starting with this part. We are starting with commercial leases and their types. So the first is your leveraged lease. Now, whenever you see this term, leveraged, means here some debt is involved. Some borrowing is involved. Okay? Always remember this. Whenever leverage term is used, some debt or some borrowing thing is going to be there. Okay. Now, as per this lease, let me tell you what we have seen just now, that here is a Mr. Amitabh Bachchan. Yes. Here is your CA Aarti. Mr. Amitabh is your lessor. CA Aarti is your lessee. Correct? Mr. Amitabh owns one house. Correct? And he is giving me the right to use this house. This is the normal lease scenario we have seen. But under leveraged lease, there is one more thing. There is one more extra thing which you are going to see. And that is here, Mr. Amitabh will take the help from, suppose, SBI Bank. Yes, now what is happening? Here, Mr. Amitabh wants to purchase this house so that he can give this house on a rental purpose. So, what is the flow here? Again, I am repeating. Mr. Amitabh, he is taking, yes, loan. He is taking loan or he is borrowing from loan and he is purchasing that house so that he can give me that house on a rental purpose. And if this is the situation, as a lessor, you are also borrowing from someone else to purchase one property which you can use for a rental purpose, then this type of a scenario is your leveraged lease. Lessor borrows money to purchase an asset and then lease that asset to the lessee. Yes, lessor Mr. Amitabh Bachchan borrows money to purchase an asset, correct, from SBI Bank, so that lease that asset to the lessee, to your CA Aarti. Correct? So ownership of the asset still remains with the lessor. Who is the owner? Mr. Amitabh only. So here we can see there are three parties. One, lessor, Mr. Amitabh Bachchan, lessee, CA Aarti, and the lender. Yes, so lessor here is your Mr. Amitabh. Lessee, CA Aarti, and lender here is your bank. Okay, so this is your leveraged lease. Then next is your domestic and international lease. Domestic means when all parties they are involved in lease transactions are domiciled in India. Mr. Amitabh is also from India. I am also from India. Our asset is also in India. So this type of a situation is a domestic lease. But suppose here international lease means if any one party is not domiciled in India. Now I want one property which is situated in Bombay, but owner is suppose your Elon Musk. And now Elon Musk is not Indian domicile person. Yes, so if I am taking property on rent from Elon Musk, Tesla owner, Elon Musk, yes, and he owns one property which is situated in Mumbai, Juhu Beach, and I want that property. Yes, now CA Aarti is also from India only. Yes or no? But here your lessor is from outside India. In this situation, this is your international lease, or you can say cross-border lease. Cross-border lease. Then next is your cancelable lease. It is cancelable as per the terms contained in the lease agreement. You can cancel it easily. But non-cancelable lease means totally opposite. It can only be cancelled upon the occurrence of some remote contingency or with the permission of the lessor. Mr. Amitabh or Elon Musk can only cancel it. Or if some uncertain situations are there, like COVID, on that situation you can cancel it. Or if the lessee enters into a new lease for the same or an equivalent asset with the same lessor. Now I don't want this Juhu Beach house. I want Delhi. Yes, one property of Mr. Amitabh or Elon Musk, they holds in Delhi. I want that property. So I'm entering same transaction with the same person, but new place. So in these three situations, I can see there is a non-cancelable act, but then also we can cancel it to get the new lease terms. Okay, so this is your non-cancelable lease. And the next one is your wet lease and dry lease. Wet lease and dry lease. So wet lease, the lessor operates the equipment and is responsible for its insurance, maintenance, etc. Means here, Mr. Amitabh, though he said that Miss Aarti, you can use that house, but all insurance payment, yes, repair, maintenance, all these things belongs to Mr. Amitabh only. He will take care of those things. But in case of dry lease, yes, things are going to be opposite. Here, all your insurance, maintenance, etc. Who will be responsible for these activities? Your lessee. Means under dry lease, CART means I am only going to be responsible for maintenance, repairs, everything. And in dry lease, yes, in dry lease, who is responsible? I am responsible. But in wet lease, owners are only responsible for maintenance, for insurance, for everything. So these are the few commercial leases. On the same note, we have two more types of leases based on accounting perspective. Okay, so I'm not starting this one, that is your finance lease and your operating lease. We are starting with few MCQs. Now let's understand how much we have understood till now. So let's solve one question. A lease is a contract under which A, ownership is permanently transferred. B, property is gifted to another party. C, one party allows use of its property to another party for a period. D, property is sold to the lessee on EMI. So tell me, under this particular question, they're asking the definition, the meaning of lease. And as per this, correct answer is your answer C. One party allows use of its property to another party for a project. Correct? So correct answer is your answer C. Then the party that owns the asset and gives the right to use it under a lease. Here they want to know the party who owns the asset and gives the right to use it. Yes, the owner is giving the right to use to be used by someone else. So the person who is giving all these things, who is the owner, that is what? Lessee, tenant, owner, lessor. Correct answer is your lessor. So you need to identify that specific term. Okay, please look for that specific term because already we have seen here. So correct answer is your answer D. You need to identify the most appropriate term. Correct answer is your answer D. Next, the periodic payment made by the lessee to the lessor is called installment, lease rental, interest, rent. Again, I am saying identify the most appropriate term. Most appropriate. Though you can say rent is also the same. No. We are solving this question based on lease. See, they are using the terms like lessee, lessor. So correct answer is your lease rental. Correct? Correct answer is your answer B. Next. Okay. So this is a quite lengthy question. So which of the following statements are correct regarding types of lease based on the domicile of parties involved? First, in a domestic lease, all parties involved in the lease transaction are domiciled in India. Second, an international cross-border lease involves at least one party not domiciled in India and includes additional risk such as country risk and currency risk. A, only statement 1 is correct. B, only statement 2 is correct. C, both statements 1 and 2 are correct. D, neither statement 1 nor 2 is correct. Everyone, now it's your turn. What do you think? So here, if you read the first one about the domestic lease, when both the parties, both the parties are domiciled in India. So here, parties involved in the lease transactions are domiciled in India. So this is true. Okay. Then, an international cross-border lease involves at least one party not domiciled in India. Includes additional risk such as country risk, currency risk. Of course, when you are dealing with Elon Musk, that time currency risk, foreign exchange rates, everything you need to follow. So this is also true. So correct answer is your answer C. Answer C.
Meaning of derivative. So if we read the definition, a derivative is a financial instrument whose value is derived from an underlying asset. Now, let's take one example here. What actually derivative means? Suppose here is Mr. B, yes, and here is Mr. C. Okay, here is Mr. B and here is Mr. C. Now, they both are watching IPL. They both are watching IPL, and while watching, they both enter into a transaction. What transaction? They made one transaction based on Virat Kohli performance. As Mr. B said, Virat Kohli will make today 100 runs. Yes, Virat Kohli will make today 100 runs. On the other hand, Mr. C said, no, Virat Kohli will not make today 100 runs. So this is a transaction. So if Mr. B, wins, Mr. C will pay 10,000 to Mr. B. Whereas if Mr. C wins, here Mr. B will pay 10,000 to Mr. C. Okay. When this type of a transaction you see, when this type of transactions you can see means something based on winning, just like a lottery, correct? So here what derivative says that there is one underlying asset. Now as per this example, 10,000 whether B will receive, whether C will receive,
totally depends on which thing? Tell me, totally depends on which thing? Whether B will earn 10,000 or C will get this? Depends on what? Totally depends on Virat Kohli's performance. Totally depends on Virat Kohli's performance. So here, Virat Kohli's performance is going to be an underlying asset. Okay, now whether you are going to win or not, that is totally depending on his performance. So how we are deriving the value? How we are deriving the value? Based on an underlying asset. So this is the meaning of a derivative. Now, in this, we have different functions of derivative. Now, always remember one thing, derivatives are always for your future. Yes, when you cannot predict, when you cannot estimate. Yes, just based on some assumptions, you are making any transaction. So, let's talk about now functions of derivatives. So, the first one is improve the liquidity of the underlying asset. Yes, this particular thing helps to improve in the liquidity of your underlying asset. Then shifts the risk from the buyer of the derivative product to the seller. Sometimes when I am afraid about future, that might I see losses in my upcoming time because of any transaction. To safeguard that particular thing, I can enter into this derivatives. To protect me from any risk, I can enter into this derivatives. So that is one more function, and this provides the better avenues for raising money. So these are the three functions of derivatives. Now, here the most important thing, that is users. This is important. Users of derivatives. So we have three users. Okay. We have three users, hedgers, then traders. First is your hedgers, then traders, and finally speculators. Okay, so let's start with hedgers. So hedgers use derivatives to protect their assets, positions from erosion in value due to adverse market price movements. Let's take one example for hedgers. Okay, so what is the meaning of hedgers? Let me explain you. Suppose I own one farmland. Okay, and in that I am actually doing farming, and after that farming I know that after 6 months, okay, after 6 months when I will be doing that harvesting, I will get paddy. Okay, I will get paddy, and I can sell those paddy into the market. But the difficulty, the problem is, if I see today's market, yes, if I see today's market, in that, if anyone is purchasing 1 kg that paddy, they are receiving 1000 rupees. Yes, if I see today's market, everyone is ready to pay for 1 kg 1000 rupees. But currently I don't have any paddy. Currently, so I am doing what? Agriculture. So here I will be doing harvesting after 6 months. So after 6 months, I will be having those paddies. So here I am having one problem, that after 6 months, if market falls from 1000 rupees, then I might face losses. Yes or no? So in today's time period, every paddy owner, they are receiving 1 kg equal to 1000 rupees. But I am going to sell this paddy after 6 months. And the fear is that in that time, after 6 months, if paddy value falls below 1000 rupees, so I will be into loss. Yes, because less than 1000 if I am going to receive, that is a loss making transaction. So because here I have paddy, yes, I have some agricultural product. Because of this agricultural product, I think I might face losses during the future. So to protect that losses into the future, I am entering into a transaction. That is what hedgers are doing. So hedgers use derivative to protect their asset. And what asset here I'm protecting? Here I'm protecting that paddy. Yes, that agricultural product from erosion in value due to adverse market price movements. So what adverse? That I think after 6 months the value might fall below 1,000. That is the adverse situation I might I might face. So that I am going to enter to protect myself from that losses in today's time, that is hedgers. So I am going to pick what hedgers to protect my position at today's time period. So I am going to be what hedgers. Okay. So here you can see fixing prices in today's time period and taking an insurance non-linear way. Either I can enter it to fix the price. Yes, I will talk to some wholesalers and I will say that I will sell these pennies after 6 months at 10,000 or whatever amount that I might feel comfortable or profitable. Yes, but if I'm not entering today and after 6 months the value fall below 1,000, then I'm going to face losses. Okay, so to protect that losses, I am going to be known as hedgers and I'm going to do hedging. What I'm going to do? I'm going to do hedging. Okay, next, traders. Now, traders are also known as your arbitrators. Yes, now traders of derivatives look for enhancing their income by making a two-way price for other market participants. See, traders, they are smart. They are smart, they are knowledgeable, they study. Yes, randomly they are not putting their money here and there. They study that market. That is the reason traders never see losses. Traders never see losses. If they feel that any transaction, if they feel T1 transaction is going to give them losses, immediately they will enter for T2 transaction. Yes, they always study and then they enter. So if you are smart, you are studying the market and then you are entering. Yes, so that is your traders, that is your arbitrators. So first your hedgers, because you hold some position. Okay, to protect that position you are entering into a transaction, that is hedgers. Next, traders who are smart, who actually study the market and then they enter into a transaction, that is known as traders. And third one is your speculators. Yes, third one is your speculators. So they are interested only in making quick money by taking advantage of the price movements in the market. So when you are not studying anything, just because of some news or some fluctuations, when you are entering into the market just to get immediate gain, yes, that is not, so those people are known as speculators. So we have different users of derivatives. Number one, hedgers, then traders, then speculators. Hedgers, they actually enter into a transaction, or you can say they enter into a derivatives to protect their asset or position. Correct? So they are entering into hedging and they are known as hedgers. Second, they are smart. They study the market and then they are entering. So they are known as traders. Third, speculators. They are interested, but they are not studying anything. Just randomly, they are going just because of after listening any news or any gain side, if they are listening, just for immediate, gain, they are entering. So they are known as speculators. So these are the three users of derivatives. Now, next thing, derivative markets. Derivative markets. So we have two types of derivative markets. Number one, over the counter. Number one, OTC, over the counter. Next, exchange traded. Okay, next, exchange traded. So here are two types of market. Over the counter and exchange traded. Now, over the counter means here contracts that are traded directly between two eligible parties. Yes, suppose here Mr. B and Mr. A. Oh, just now we have taken one example, now that IPL match example. Yes, so let's continue with that. So here Mr. B and C. Okay. So when two eligible parties, when they are entering, yes, like Mr. A, Mr. B and Mr. C, they both entered into a transaction to actually get the benefit, yes, out of this derivative. Okay. So when two parties are there, two eligible parties are there, with or without the use of intermediary and without going through an exchange, means here they are entering directly. Yes, they are entering into a transaction directly without involving any third party. So that is what over the counter, OTC. The parameters of the contract, like the size, maturity, are not standardized. Yes, are mutually agreed between the parties to a contract. Here, Mr. B and C, they both will decide what we need to do, what things we will be doing, yes, what will be our transaction date, what thing is going to be our underlying asset. So when two individual people, they are entering into a transaction without involving any intermediary or any exchange traded, then that is over the counter, OTC. Then next, that is exchange traded. Exchange traded means that is the involvement of your Bombay Stock Exchange and National Stock Exchange. Yes, that share market. Okay, and when you enter into any transactions in share market, you need to follow SEBI guidelines. Like in banks, you have Banking Regulation Act now. So same if you enter into National Stock Exchange, Bombay Stock Exchange, you need to follow SEBI guidelines. So here, if we talk about exchange traded, these are the derivative products that are traded on an exchange. Take exchange means what? National Stock Exchange, Bombay Stock Exchange. So the maturity and size of these products are standardized by the exchange. Here you are going to see three parties, Mr. B, Mr. C, and here is your National Stock Exchange. Yes, here you are going to see three parties. Three parties. Yes, Mr. B will enter and Mr. C, again they both will enter directly with National Stock Exchange. Okay, and these two parties are going to be unknown. Here in NSC, that is National Stock Exchange, they are going to make the transactions for the interested parties. So this is your exchange traded transactions. Here you're going to see three parties. Okay, now trade in this derivative products can be done only through a member of the exchange by paying the initial margin and maintaining variable margin account. Here everything, the agreement, everything will be handled by your National Stock Exchange, that exchange traded market. So these are the two types of derivative markets: A, over the counter; B, exchange traded. Okay, so we have completed users of derivative, hedgers, traders, speculators, and then we have completed derivative market, over the counter, exchange traded. Now, next important thing, regulators of derivatives. Regulators of derivatives. Now, when we talk about regulators of derivative, we have again two. First, RBI, second, SEBI. Yes, RBI regulates interest rate derivatives, foreign currency derivatives, credit derivatives regulated by RBI. But when you are involving stock exchange, National Stock Exchange, Bombay Stock Exchange, that time SEBI regulates stock market and FMC regulates commodities futures market. FMC means here Forward Markets Commission has been this merged with SEBI with effect from September 28, 2015. Now we have only one regulatory body, that is your SEBI. So we have two different regulators of derivatives. Okay, again I am repeating, RBI and SEBI. We have two regulatory bodies, RBI, SEBI. Now, if we repeat it again, like derivatives market, we have two, that is over the counter, exchange traded. And if we talk about users of derivatives, we have three: hedgers, traders, speculators. Okay, and then if we talk about regulators, we have two: RBI and SEBI. So these are the two regulators of derivatives. Now, we are going to talk about different types of derivatives. What we are going to talk? We are going to cover next thing, that is types of derivatives. So the first type is your forwards. Yes, the first type we are going to see, that is forwards. Then next type we have futures. Third type we have swaps, and the fourth type that we have, that is your options. So here are four types of derivatives. Let's revise it again. Forwards, futures, swaps, and options. So these are the four types of derivatives. Okay, forwards, futures, swaps, options. Now let's discuss this one by one. So the first one is your, that is forwards. So let's start with the first one, that is forwards. Forwards are your private agreement, yes, in which you have only two parties, that is party B and one party, that is your C. Yes, so this is your over the counter contract where you buy and sell in future at fixed price. Now used to avoid risk for price changes, but remember one thing, not traded on exchange rate, and commonly we use in forwards. So this is your forwards. Now next type that we have, that is your futures. So like forwards, but traded on stock commodity exchanges. So same like your forwards. Okay, we have one more, futures, but this time we are going to take the help of your standardized contract, more liquid than forwards. And how we calculate future price? Spot price plus cost minus income. And this is available for currency, bonds, stock index, etc. Yes, so here you can say you are going to involve National Stock Exchange. So these are the two types of derivatives that we have just now covered. First, forwards, where there are only direct parties when they are entering into a contract. So Mr. B and Mr. C. Yes, that is your over the counter. Next, futures, like forwards, but traded on stock and commodity exchanges. You can say this is your exchange traded contracts. The third is your swaps. So exchange of cash flows between two parties. So here we can say where there are different types of swaps. First, interest rate swap, currency swap, basis swap. Now interest rate swap means, suppose here is your Mr. A and here is your Mr. B. Okay, here Mr. A has taken loan based on fixed rate, whereas Mr. B has taken loan on fluctuating, or you can say floating rate. Fixed rate, floating rate. Yes, but after 6 months, suppose now Mr. A wants floating and Mr. B wants fixed. So when they're changing the rate, yes, fixed to floating, floating to fixed, if they are changing this interest rates, then that is interest rate swap. Swap means what? Exchange. Hana, like a barter system. So this is your first is swap, that is interest rate swap. Now next is your currency swap. Currency swap means here including your interest principal, you are changing the total amount. Suppose here Mr. A is again there. Here Mr. A and here is your B. Yes, so Mr. A has taken loan in suppose Indian INR, whereas B has taken into dollars. Now Mr. B wants Indian rupees loan and Mr. A wants in dollars. So when they are changing the whole currency only, then that is currency swap. Now basis swap means suppose you are changing the floating rates interest only. Okay, you are changing floating to floating, then that is basis swap. Now, why we use this? Generally for hedging purpose, asset liability management, reducing cost. But in India, banks can trade swaps with INR leg only. Foreign leg needs back-to-back cover. So in India, which a swap is permissible? That is INR lag. Now, the fourth type of derivative that you can see, that is options. Now it gives right but not obligation to buy sell asset. Yes, here buyer pays premium to seller. See, option means what? Option is the compulsory thing? No, I am giving you option to go with to go with this transaction or not. So I am giving you option. Yes, that is not an obligation. I am just giving you option to go with commerce or go with maths. So either of that you can opt, or you can just say I don't want anything. So that is your options. This gives right but not obligation. So here buyer pays premium to sell it. Okay, so here you have two types of option: call option, put option. Now call option means you are giving right to buy. You are giving right to buy means here you are giving right to your seller. Yes. Then put option means right to sell that you are giving to your buyer. So these are the two options: call options, put options. Then again in this you have European option and American option. So European option means exercise only on expiry. Suppose I entered into a transaction and I said the last date of this transaction is going to be 31st December 2025. And suppose transaction that is European one. So that the date that I will say our transaction is over, that is going to be only and only on 31st December 25. But American option says exercise any time before expiry. If I am entering in November, October, if I am having that option in my hand, then that is American option. So here are two types of option: European option, American options. Yes. So here we complete different types of derivatives as well. So again, let's revise: forwards, futures, swaps, and options. Now let's start with MCQ. So financial derivatives includes stocks, bonds, futures, none of the above. Tell me. Financial derivative includes only futures. Correct answer is your answer C. Then next. Which of the following is not a financial derivative? Stock, futures, options, forward, contracts. Which is not a financial derivative, everyone? We have only four types of financial derivatives. Just now we have completed: forwards, futures, swaps, options. So here stock is your right answer. Correct answer is your A. Then which of the following is a reason to hedge a portfolio? A. To increase the profitability of gains. B. To limit exposure to risk. C. To profit from capital gains when interest rates fall. D. All the above. So why as a hedger I will enter into a transaction? To protect my position if anything gives me the losses. So to protect, to limit the exposure to risk. Correct? So the correct answer is answer B. What is this tax? Yes, you must have heard about this tax, and so many of you are also paying income tax. Yes, GST you must have heard. So all these things are coming under tax. But what is the real meaning of tax? So tax is what? Tax is a fee. Yes, tax is a fee that is charged by government on a product, income, or activity. Yes, product means when you are purchasing goods. Yes or no? When you are doing any activities or when you are providing any services or income, income like your salary, profit. So whenever you are gaining anything, yes, whenever you earn any income, yes, any gains, that time you need to pay some small portion to the government. Now, why we are paying to the government? Because that is the only source of government so that they can earn revenue. See, because here government will take money, yes, in the form of taxes from individuals, yes, from your salary, from GST, and from this money they are going to do the expenditure. Yes, they are going to do expenditure. They are bringing so many schemes. Yes, they are making infrastructures. Correct? All these things then government is actually doing. So for this expenditure they require amount. Yes, they require cash. And who is giving this cash? We all are paying indirectly or directly cash to the government. Yes, so this is what tax is. Tax is a fee. Tax is a fee that charged by government, okay, on any product, income, or activity. Now we have two types of taxes. One is your direct tax and next one is your indirect taxes. First one, that is your direct tax. Direct tax, that is the tax we are going to cover in this unit. So the 29th unit is about your direct tax only. Here we are going to cover your taxation, especially that income tax, TDS and deferred tax, which is your direct tax. Now, direct tax means when you are paying taxes directly to the government. Yes, means here as soon as you are earning salary. Yes, here you are earning salary and you are paying directly income tax return to government. So that is your direct tax. That is what that is your direct tax. Means here is direct payment. Here is direct payment to the government and that is direct tax. Yes, here you're paying directly income tax return to government. Now, then what is indirect taxes? Here is your consumer. Yes, here is consumer. Now consumer pays to some middleman. Yes, there are some middlemen and then they are paying to the government. Yes, that's the difference between direct and indirect. In direct, you are paying directly taxes to the government. But under indirect, you are paying to the middleman or to any third party, and then they are paying to the government. Means directly you are not paying any taxes to the government. So this is about the meaning of tax, and these are the two types of taxes. I hope you have understood this part. Now, coming to the next part, that is especially taxation related to direct. And in direct taxes, we have income tax. Under direct tax, we need to complete Income Tax Act. Yes, through this Income Tax Act only, you are paying income tax return. Yes, through this act only, you are paying income tax return. Your employer, your bank deducts TDS on your salary and they pays this tedious amount to the government before crediting in your account. So, which act we are following? We are following Income Tax Act. Now, Income Tax Act, this is based on ability to pay principal. Ability to pay principal means what? Higher you earn income, higher tax you need to pay. The more you are going to earn your income, the more amount you need to pay. Means what? See, if I talk about Mr. A and if I talk about Mr. Ambani, yes, here Ambanis are earning 10 crore, suppose per annum. Yes, this is their income. And here Mr. A earns 12 lakh rupees. Yes, this is the income, this is the salary which is earned by Mr. A. Now tell me, what do you think? Mr. A and Mr. Ambani both are going to pay same tax? The answer is no. है Mr. A will pay as per 12 lakh slab. Yes, Mr. Ambani will pay as per 10 lakh crore income. Yes, so here who will pay more amount of tax? Mr. A or Mr. Ambani? What do you think? Who will pay greater amount of tax? Mr. A or Mr. Ambani? Of course, Mr. Ambani. Yes, Mr. Ambani is going to pay higher income. So this is the phrase they are using. Ability to pay principal means higher you earn, higher you need to pay income taxes. So this principle is an economic term that states that those who earn higher income should pay more taxes. Okay, this is overview of Income Tax Act. Now, next, PAN number. Yes, PAN. Now, PAN means what? PAN card, that is permanent account number. PAN card. Yes, permanent account number. I hope everyone holds this as we all are Indian citizens. Yes, so this is our required document. Yes, so let's talk about PAN number. Yes, so here this PAN number issued by Income Tax Department. Who issues your this PAN card? Income Tax Department. Okay, now if we talk about PAN number, that unique number, yes, like we have Aadhaar number, correct? We have that Rasha number, then so many driving license numbers, etc. For ID proof, we use this. So here, if we talk about this PAN number, so here this PAN, that unique number, that is going to be around 10 digits. 10 digits. This is your unique PAN card. Yes, this is a unique number. This is 10 digit. 10 digit alphanumeric number. Alphanumeric means, see, if I break this term, alphabets like A, B, C, D, that is what your alphabet. Numeric means number like 1, 2, 3, 4, 5. So, PAN card is the combination of both the things, alpha plus here numbers. That's why this is your 10 digit alphanumeric number. And you can use this PAN card across country. Yes, that is valid document which you can use in any places, whether you are using it Kanyakumari, whether you are using in Jammu Kashmir, whether you are using in Gujarat or any Assam, Meghalaya, any states. You can show this as your valid ID proof. So this is your what PAN card. Now, this term is very important, and the term says that last point says mandatory to link PAN to the Aadhaar number to without fraudulent PAN cards. Now, government always says to link your PAN card with your Aadhaar card. Yes, so that if anyone is trying to do the, fraud, easily they can identify it. So these are the features, and however PAN card is, that is what given in this topic, and this is very important, and they can ask for direct 1 marks or zero point 0.5 marks. Yes, so this is about PAN number. So firstly, we have understood about that tax meaning. Yes, then we have seen about income tax act, then permanent account number. Now coming to next important point. Now this is very important, so let's start with classification of income tax payers. Now I'm starting with income tax payers. See, income, yes, that you are earning in the form of salary. Yes or no? That is your income or not? Yes, that is your income. Then read this term, tax payers. Tax payers. Payers means someone who is giving something. But what we are giving? We are giving tax, and we give tax on what? We give tax on our salary. Yes, we give tax on our salary. So this is a classification of income tax payers. Yes, taxpayers, like you all are paying income tax to the government, so you all are known as income tax payers. Yes, so as individual you are paying, here companies are paying, so we all are covered under income tax payers. Whenever you pay tax on your income, on your salary, you are going to be classified under this income tax payers. So this income tax payers given under the section 2 of the Tax Act. So here we have different types of taxpayers. So again, like if I take one example, here is Mr. Amitabh Bachchan ji. Yes, here is Tata Company. Yes or no? Here is your this Reliance Company. Here is Mr. X. Yes, here is your some partnership firm. You must have heard about these things. Yes or no? So whenever these type of taxpayers, yes, this type of different taxpayers are there, they all are paying tax. Yes or no? They all need to submit tax. But can we say they all are natural human beings? Can we classify under just one head? Can we say that they all are natural human beings? The answer is no. You cannot say this. This all are your what natural human beings. So if these taxpayers are not just one natural human beings, then how to classify it? Because government, when they are receiving the tax, they want to know which type of a taxpayer you are. Yes, companies are paying in a different tax rate, and as an individual, you are paying in a different tax rate. So let's talk about one by one. So under Section 2 of the Income Tax Act, first classification is given as an individual. As an individual. Yes, individual means natural human being. You all are natural human beings. Includes unsound mind. Yes. So here, if we talk about Mr. Yes, Amitabh, Shahrukh, SRK, Virat Kohli, yes, etc. You are also earning. So you all are classified as an individual. You all are classified as natural human being. Okay, now next classification is your HUF, that is Hindu Undivided Family. HUF. So if you're from Hindu family or if you're from Jain and Sikh family, then you are automatically, you can create this HUF. Now this is HUF, that is Hindu Undivided Family, given under Hindu law. So here HUF is a family which consists of all person lineally descendant from common ancestor. Your great grandfather, your father, then your upcoming generation, they all can form under this HUF. Like family businesses, yes, they can form this HUF, and this is created automatically. Yes, this is created automatically. There is no requirement to pay any special fees like when you are forming companies. Yes, there is no requirement to pay to go under that. Anyone, if you are from Hindu family, if you're from Jain family, if you are from Sikh families, you can easily create this HUF. So this is a second type of a taxpayer. First type of a taxpayer, that is an individual. Next type of a taxpayer, that is HUF. Now coming to next type of a taxpayer, that is company. Company. Now company can be your Tata company. Yes, company can be your Tata company. That can be your Tata company. That can be Amazon. Yes, Apple company. But Tata company is a domestic company. Now, why they are classified as domestic company? Because they are registered in India. They incorporated their business in India. And if any company which incorporates their business in India, they are known as domestic company. Like Reliance, yes, SBI, all these are covered under domestic. But if you registered outside India, yes, you started your business, you incorporated your business outside India, then you are going to be called as foreign company. Like Amazon, yes, Apple, Facebook, all these are incorporated outside India, so they are known as foreign companies. So if you are a company, yes, like private limited, public limited, government company, or if you are foreign company, you are going to be classified under company. Company includes both the companies, domestic as well as foreign. But remember, we use different rates for tax for the domestic and for foreign companies. Yes. Next, that is a firm and LLP. Next type of a classification, next type of a taxpayer is your firm and LLP. Limited liability partnership firm, partnership firms. Yes, so here under Income Tax Act and GST, firm is separate legal entity. Under partnership law, it is not a legal entity. But remember, LLP is a body corporate. LLP is a body corporate formed and incorporated as per Limited Liability Partnership Act 2008. Like for banks, you have Banking Regulation Act. For making company this limited liability partnership, there is one act given by Limited Liability Partnership Act LLP Act 2008. 8. Now, LLP also holds separate legal entity. Separate legal entity means their owners, their founders are going to be different and separated from their firm. Contains the elements of corporate and partnership firm. Like law, if we see advocates, they are opening this firms. They cannot open company. Yes, chartered accountants, they cannot open companies. They are allowed to open only this firms. So this is about LLP and firms. Now, all firms and LLPs are taxed at flat rate of 30%. Yes, flat rate of 30%. So this is about income tax payers. And we have seen individuals, HUF second number, third number company, fourth number firm and LLP. Then we have fifth number, sorry, that is association of persons or body of individuals. So association of persons means like here is your individual, company, HUF, yes, firm, LLP. When you can see different types of taxpayers are coming together, you are going to be known as AOP. On the other hand, we have one more term that is body of individual. So body of individual means when individuals are coming together, like Mr. Amitabh, Virat, Mr. X, Y, Mr. A, B, C, when individual persons are coming together, when you are forming one group, then that is known as body of individuals. So whether that is incorporated or not. Yes, whether that is incorporated or not, their objective is going to be to earn income, profit, or gains. So these are the different, different types of taxpayers. Just now we have seen. Let's revise it again. We have started with individual. Then next we have seen about HUF. Yes, after that we have seen company, firm and LLP, AOP, BOI. After that, we have one more classification, that is a sixth type of a classification, that is local authority. So local authority includes your municipalities, panchayats, etc. Okay, which is a sixth type of a classification, local authority, in which we include municipalities and panchayats. And the last one, that is your AJP, artificial judicial person. So if you are not fallen in above 6 taxpayers category, you can use this category as AJP. When entities are not covered any of the above category, then they are included in the definition of AJP. So only these type of 7 types of taxpayers we have. Let's revise it again. First, individual, HUF, company, firm, LLP, AOP, BOI. Sixth one, local authority, and the last one is AJP. If you are not falling under any of the above categories, you can use AJP to submit your income tax return. So these are the different types of taxpayers, and these are very important from exam point of view. So let's solve few questions based on this. First question: who is responsible for determining the applicable tax rate and calculating the tax payable income tax in India? Taxpayer, income tax department, chartered accountant, all of the above. Who's saying that this tax you need to charge? On this income, you need to pay tax. Who is giving all these things? This is given by income tax department. Yes, here taxpayers are following income tax department. Chartered accountants are also following them. Yes, so that's why D is not your correct answer. Correct answer is your answer B. Next. Income tax department in India mandated linking PAN with Aadhaar. Why they have made this as a compulsory norm? A. Improve taxpayer convenience and simplify tax filing. B. Streamline government benefits distribution without fraudulent PAN cards. D. Track individual financial transactions more effectively. So what do you think? Why there is one compulsory criteria to mandatory link your PAN with Aadhaar so that you can without fraudulent PAN cards. Correct answer is answer C. Okay, now next question. Which of the following statements accurately describes the permanent this ban in India? A, B, C. You have 3 statements and you need to choose the most, accurately representing the true characteristic of PAN in India. Okay. First, PAN is unique 11-digit number. Okay. In the first option, they are saying 11-digit alphanumeric issued by Income Tax Department. B. PAN is a unique 10-digit alphanumeric number. C. PAN is unique identifier issued by Income Tax Department, but it changes if you move to different state or update your name. So if you are changing, or like in your banks also, if you are relocating, you need to issue or you need to apply for a new PAN. No. Hana, so C is not your answer. What about A and B? C is not your answer. Tell me. A, again, A is your wrong answer. Yes, A is your wrong answer because they are saying 11 digit. We don't have 11 digit, we have 10 digit. That's why correct answer is only and only answer B.
Working capital. Yes. Now, capital means what? Capital means fund requirement. Yes, this is funds. So, in your organization, or if we talk about any entity, yes, so we require funds for two things, correct? For running, yes, for day-to-day activities also we can say, and for purchasing of long-term assets. Yes, for purchasing of fixed assets. Yes, for example, land, building, machinery, equipment. Yes or no? All these things are required for your long-term time period. Now, in this particular unit, we are going to talk about this side. We are not going to talk about this fixed assets. No, we are going to deal only with this funds, which helps you in running of your business. Okay, so when you are taking any funds, or when you are calculating those funds which will help you for your day-to-day expenses, for running your business, that is your working capital. That is your working capital. Now, working capital, this is also known as net working capital, NWC. Now, the amount of money a company has available to operate after deducting its current liabilities from its current assets. So, formula is current assets minus current liabilities. This will give you working capital. Current assets minus current liabilities. This will give you working capital. Yes, current assets like your inventory, accounts receivable, prepaid expenses, cash on which you hold ownership. Current liabilities, your short-term liabilities, which is less than 12 months. Correct, like accounts payable, payroll, rent and utilities. All these are your current liabilities. So when you subtract current assets minus current liabilities, you will receive working capital for your expenses, pay suppliers, grow businesses. Mainly you can say your day-to-day amount that you require for running. That is what working capital talks about. Now, one more term that is related to it, that is working capital cycle. Now, this working capital cycle means when you are starting your business, yes, you are going to arrange cash, or you can say funds. Yes or no? When you are starting your business, you are arranging the funds. After this, you will purchase raw material. Now, after this raw material, you will do processing. Yes, so that you can convert this into finished goods. And then this finished goods you are going to sell to your customers. And finally, customers will again pay you this cash. Again, customers will pay you cash. Means as soon as you complete this cycle, yes, as soon as you complete this cycle, one cycle, as soon as you complete from cash to again cash, that is your working capital cycle. You start your business with cash. and then you purchase raw materials, then you do the processing, then you manufacture finished goods, and then you sell those finished goods to your customers, and finally you will receive cash. So when you complete this cycle once, that is your working capital cycle. Okay, now let's read the definition. So in normal operations of a business consist of some or all of the actions like purchase of raw materials, processing, conversion of raw material into finished goods, selling these goods to the cash or on a credit basis, and finally receive cash on sale or end of credit period, again purchases raw material. When you complete this cycle, that is your working capital cycle. That is your working capital cycle. Now, in case of working capital cycle, for arranging this current assets, yes, for purchasing this raw material, for processing, for manufacturing or converting into finished goods, we require current assets. Now, for acquiring those current assets or for purchasing those current assets, we require funds. Correct? We require funds. So, there are so many sources through which you can arrange funds. So, approximately we have 10 sources of funds through which you can arrange here money. Number one, that is firm's own working capital funds. Number two, accruals, trade credit, working capital advance by commercial banks and financial institutions, public deposits, intercorporate deposits, rights, debentures for working capital, commercial paper, and then factoring and forfeiting. So these are the different sources through which you can acquire, purchase current assets. So let's start with the first one, that is your firm's own working capital fund. Yes, for example, when you are earning salary, yes, suppose you are earning rupees 1 lakh per month. Correct? Now from this 1 lakh per month, you are also doing some savings. Correct? Suppose you are saving 15,000 per month and rest of the amount you are expending. Okay. Now this amount, in case of emergency, in case of purchasing any goods, you can use it. So this amount when you are using, that is your own amount. Yes, when you want to purchase any goods, any expenses, investments, whatever you want to do, you can do with that 15,000. The same thing businesses are doing. For example, here if we talk about Reliance, suppose they are earning here 10 crores. Yes, now from this 10 crores, might be they are giving 2 crore as dividend and remaining 8 crores they are reinvesting. Yes, they are reinvesting. Means they are using their own fund. They are using their own fund. Now from this 8 crore also they can use it for purchasing raw materials or for purchasing long-term assets. That totally depends on management. What decision they want to make. Correct? So here if organizations uses both long-term sources, that is equity capital or debt capital, and short-term sources. See, long-term sources means whose life is going to be more than 12 months. On the other hand, if we talk about short-term, whose life is going to be less than 12 months. Yes, so from both the ways you can arrange the funds. That is what firms own working capital funds. They can acquire equity, they can take debentures. Here debt capital means here your borrowing side. Yes, in borrowing you can take from bank, that term loan, correct, debentures, bonds, these things companies can use for taking money. Now, under this net working capital NWC limit, bankers in India expect this proportion to be a minimum of 25% of the total current assets. In India, what NWC as a banker you can expect? That is 25% of the total current assets. So here uses of NWC, that net working capital, that margin money brought in by the firm for acquiring current assets. Now when company arranges this working capital fund, for what purpose they are going to use it? For acquiring current assets, for purchasing stock. Correct? All these things are actually used for acquiring your current assets only. So here, if we solve one question, now this question is from your IFBF book. So make sure you are solving it. The total requirement of current assets of a firm is estimated at 100 lakh. The firm has arranged short-term finance of rupees 75 lakhs from various sources. Now, what is the amount of margin that is, or you can say NWC required to be brought in by the firm? Okay, so total requirement. Here if we see the solution, total current assets that we want, that is 100 lakh. Yes, and how much we have arranged through short-term loan, that is 75 lakh. Correct? So, from different sources you have arranged 75. What is the amount of margin NWC required to be brought in by the firm? That is here 25 lakh. Yes, and what will be the current ratio of the firm? So, for the current ratio, you need to use current assets divided by current liabilities. So, can you solve this and tell me the answer now? So, current assets already given here, that is 100 lakh divided by 75. So, if you solve this, 100 divided by 75, so your current ratio is going to be 1.33. This is your answer. Okay, for the first part, your answer is this one, and for the second part, your answer is 1.33. So this is the first way through which organizations are arranging funds. They are using their own amount. Now, second is accruals. Second, through which they can arrange or they can acquire current assets, that is accruals. Now, accruals means what? See, if you have completed your work, yes, work performed, and you have accrued revenue. Yes, when you complete that work, after that your amount is going to be accrued revenue and client pays later. Correct? On the same hand, if you see materials brought on credit, as soon as you brought materials on credit, means without paying any cash, that is going to be your accrued expenses and company pays later. Yes, you are purchasing goods on credit. That is the next thing you can use for acquiring, for getting current assets. So here, accrual represents the liability of the firm which has already accrued, but the payment for it will be made after some time. For example, if you are working, yes, you are working in this whole July month. Yes, from this 1st to this 31st, every day you are working. So on this 31st day, there is liability on your bank to pay you the salary. But if they are not paying you till suppose 7th August, if no salary is credited in your account, then in the books of your bank, they are going to write it as accrued expenses. Yes, accrued. Their liability is there to pay on 31st July, but till 7th, there is no payment. So that is what accruals. Next, third one is your trade credit. Trade credit. Now, trade credit means here you have a buyer, here you have a seller. Check it. Here is one buyer, here is one seller. Now, here buyer is your customer and allowed to purchase goods or services. Here buyer purchases goods or takes the services without paying money upfront. Means suppose if I am purchasing this calculator from you, I am not paying any credit right now. Check, I am not sorry, I am not paying any cash. I am just purchasing this asset. And you are saying, okay, you can pay after 30 days. You can pay after 45 days. So that's the normal credit time you are giving to your each and every customer. Or you can say in a market, this is the standard time which you are providing so that customers can purchase your goods and after some time they can repay it. So when here your seller, they are providing this, limit. They are selling the goods on credit basis, then that is trade credit. So through this also you can purchase your current assets. Yes, due money can be paid later as mentioned in the term of sale. You can create documents like bills of exchange and your promissory note. You can create those instruments and through that you can purchase goods. So here trade credit is a negotiated delay in payment extended by suppliers to the firm. Here is no negotiation. Yes, here is no agreement. There is no agreement between you and your bank that they will pay on 7th of August. Correct? But under this trade credit, we are creating one agreement on which we will see mutual agreement. Correct? So here it is significant short-term financing source. It is again short-term financing source means less than 12 months. You can see the factors which can influence suppliers' credit offer like industry practice, firm's payment history and reputation, liquidity position, profitability and in recent years. So these are the few trade credits which are available. Now coming to the next one that is again important, that is working capital advance by commercial banks, financial institutions. Yes, so like types of working capital facilities you can see like fund-based facilities, cash credit, overdraft, loans, bills purchase and discounting in which bank is giving you cash. Okay, bank is supporting through cash. On the other hand, we have one more facility that is non-fund based facilities. Means here they are not providing you any cash, they are supporting you like giving LC, bank credit, co-acceptance of bills. No cash flow is there in your second condition. Second condition is your non-fund based facilities. Now here who provides it? Mainly we talk about commercial banks and financial institutions only in exceptional cases. Majority of the times all this short-term working capital is provided by the banks, and in some cases you can get this from your financial institutions also. Then regulation of working capital finance. Earlier RBI prescribed norms for inventory and receivables. Earlier RBI used to provide guidelines, but now deregulated it and banks have freedom to access and sanction limits using their own judgment. Now bank to bank that will differ. Yes, now RBI gave the right to actually to the banks that if their judgment is okay after checking everything, if they feel so, they can give the amount. So this is about the fourth one, that is fourth type of source of finance, that is your working capital advance by commercial banks and financial institutions. Now let's see the next one, that is your public deposits. Now public deposits means a firm can raise funds through public deposits, but remember if you are a private company you cannot raise anything from the public. Yes, so if you are raising from the public means here you have received the right and you are a public limited to finance its requirement of current assets. Interest rate of the deposit is not regulated by RBI. Again, who will decide what interest rate they are going to pay to the public if they are borrowing from the public? Totally depends on the management. Then, depends on firm's financial stability, reputation, prevailing market conditions. And here, this 2013 Companies Act provides how you can borrow from the public. This is your fifth way through which you can arrange funds to acquire current assets. Now, next one is your intercorporate deposits. Means what? Here is your Reliance Industry. Now they are taking funds from Tata. Yes, Reliance wants fund, so they will take from Tata. That is what intercorporate deposits. Now this is again short-term deposits, and mainly this is from 3 and 6 months. Yes, this is from you can say or up to 6 months accepted by a company from another company. Reliance this accepted from Tata this short-term funds, that can be 3 months fund or 6 month fund. Now, features are you can procure procedures simple, but regulations regarding such deposits are not strict. And here interest rate is also not fixed, because again companies, their management, they are going to decide what interest rate they are going to charge. So this is your next type of source through which you can arrange funds for your current asset, that is your intercorporate deposits.
Most of times you have seen this type of a bills. Yes, and on that bill you must have paid some CGST and SGST kind of things. Yes, but when to pay this type of taxes and who is calculating this? Yes, and what is the meaning of this CGST, SGST? Sometimes you must have seen about IGST. So what all these things are, we will be talking about these things under this particular unit only. But before that, let's talk about GST, and before that also let's talk about indirect taxes. So in your previous session we have seen that when we talk about taxes, that is a fee. Yes, if anyone asks you about what is the meaning of tax, that is fee. Yes or no? Which is charged by government. This is a fee amount which is charged by government. Now, when we talk about the fees, this divides into two different types of fee through which government collects the amount. Yes, that is your direct and indirect. Direct, under that we have covered income tax. Now today we are going to cover indirect taxes, that is your GST. So indirect taxes are the taxes which can be shifted from one person to another entity. Yes, like you can see here, if here is your this wholesaler. Yes, wholesaler will supply goods to the shopkeeper, and shopkeeper will supply goods to consumer. Now ultimately when this consumer, that person is paying, that person is only responsible for paying the tax. Yes, where if we talk about shopkeepers, if we talk about wholesalers, if we talk about manufacturers, they all are getting refund. Yes, they all are getting refund about the taxes they have already paid. But as an individual, we are only paying the tax. We are not getting any benefit. Yes, so that is what, that is indirect taxes. You can shift your burden to your next person. That is what indirect tax talks about. Now, next thing, that is your GST. So under this goods and service tax, earlier we under this indirect taxes, earlier we used to have so many different types of taxes, correct? Like your service, VAT, SAN VAT, octroi. But because of these many taxes, there was so much confusion. Yes, when to apply which and what rate we need to apply. Every state is talking about that time they used to talk something different. So that was very difficult as a layman person, for individuals, for companies, for everyone. Those type of taxes were different. But from 1st July 2017, government decided to merge different type of taxes and form one tax, that is goods and service tax. One nation, one tax. Goods and service tax. So now let's talk about the definition. All transactions such as sell, transfer, purchase, barter, lease, or any import of goods or services, everything is covered under GST. Yes. Now, whatever type of transactions you want to do, every type of transactions, if that is dealing in your goods and services, that will be covered under GST. And this GST introduced from 1st July 2017. Yes, this GST recently we have seen from 1st July 2017. Correct? Now, and it's a destination based tax. GST is what type of a tax? Destination based tax means where you consume the goods, only on that place you need to pay the taxes. That is what destination based tax. Now, under this GST, we have some exempted goods and services also, like your crude oil, petroleum products, alcoholic liquor for human consumption, and electricity. Yes, so under this GST, we have some exempt GST goods also. That is the crude oil, petroleum products, electricity, alcoholic liquor for human consumption. Now in exam, they can ask direct question based on this. Now how you can remember this? Use cap. Yes. Use this term cap. C means crude oil. P means petroleum products. A means alcoholic liquor for human consumption. E means electricity. You can use this particular cap for remembering exempt from GST. So this is about the introduction about GST. Yes, under GST you are going to cover each and everything. Now, there are different types of GST in India. Okay, the first one, that is your SGST, next is your CGST, then you have IGST, and finally you have UGST. Only these 4 types of GST we have under this tax. SGST means State Goods and Services Tax. CGST means Central Goods and Services Tax. IGST means Integrated Goods and Services Tax. UGST means Union Territory Goods and Service Tax. Only these are the 4 types of taxes covered under GST. Now, let's talk about the first type of taxes, that is your single state transactions. Yes. Now, based on different transactions, we need to apply different taxes. And we have only 4 taxes. You can apply CGST, SGST, or you can go with IGST, or you can go with CGST plus UGST. Only these 4 taxes only you can apply when you are doing any transactions related to any goods or any services. So the first type of transaction that we are going to cover, that is your single state transaction. Okay, so here is your Maharashtra state, correct? Now in this Maharashtra state, here is your seller. Yes, and in this Maharashtra state only you have your buyer. Yes, here is only within the same state boundary you have your seller and you have your buyer. Now, here seller will supply goods. Yes, seller will supply goods or services. Yes, so seller will supply goods or services, whatever buyer demands. Now, in return, buyer needs to pay. Yes, buyer needs to pay some amount, then only they can complete this transaction. So, by completing this transaction, here buyer pays cash. Now, if we talk about goods, if we talk about services, if your goods are not exempt under GST, you need to pay GST on that. And under if we discuss about exempt goods, we have only 4 different types. A, that is your crude oil. B, that is your alcoholic liquor for human consumption. C, that is your petroleum products. And D, that is your electricity. Yes, only these 4 things are exempt from GST. Apart from that, every goods are covered under GST. Now, if we are dealing with goods or any services, you need to cross-check whether you need to pay GST on that product or not. So here, If the goods are not exempt, then you need to charge GST. Yes. So as a buyer, you are going to pay cash. Along with this cash, you need to pay GST. You need to pay tax amount. But out of 4 taxes, yes, you have CGST, you have SGST, IGST, UGST. Only these 4 taxes are covered under this. But which type of a tax we need to charge? Now, the most important point from this topic. Whenever you see single state transaction, yes, means your buyer is also in that same state, your seller is also in that same state. If both the parties belongs to the same state, you are going to charge SGST plus CGST. Which 2 taxes you will charge? SGST and CGST. Now, SGST will be collected by state government. Yes, this will be deposited to your state treasury. CGST, this will be deposited to your central government. Okay. So remember one point, whenever you have same state transactions, in that you are going to charge 2 types of taxes under GST, SGST and CGST. Correct? So this is your first type of a transaction. Now what if you are purchasing from any other state? Yes, so now let's talk about it. Suppose your seller, yes, that is again from Maharashtra only, and now this time buyer is from Gujarat. Okay. So here seller again supplies goods or services. Yes, goods or services again supplied by buyer. Now as a seller. Now as a buyer, what he will do? Of course, he will make the payment in cash plus GST he needs to pay. But out of 4 GSTs, we need to pay which type of a GST? This is not your same state transaction. Yes, this is not your same state transaction. You cannot say your buyer is also from this Maharashtra, your seller is also from Maharashtra. Can you see that? The answer is no. So are you going to charge CGST plus SGST? Again, answer is no, because we know that condition when we need to charge CGST plus SGST. Correct. Now, in this case, when you have 2 different states, means when your goods are crossing state boundaries, at that time you are going to charge only and only IGST. Here, under this situation, you will charge IGST. Yes, IGST whenever your goods are crossing state boundaries. Listen to me very carefully what I am saying. Whenever your goods are crossing state boundaries, you are going to charge 1 type of a tax under GST, and that is IGST. Okay, now earlier we have seen about 4 types of taxes. Yes, we have already discussed that we have 4 types of taxes: CGST, SGST, IGST. Okay, CGST and SGST you are going to charge when there is same state transaction. IGST when you cross state boundary. Okay. So when we need to charge the 4th one, that is UGST, related to some union territory and goods. So now let's talk about it. Okay. So the 4th one, that is the UGST. UGST is applicable for union territories only, and we have only 5 types of union territories given under your GST. Okay, remember under your GST you have only 5 types of union territories. First, Andaman and Nicobar Island. Second, Lakshadweep. Third, Dadra Nagar Haveli, Andaman and Diu. Fourth, Ladakh and Chandigarh. Only these 5 types of union territories are given under your GST. See, this is given under GST Act. Okay, so we need to follow that act only. You cannot say that in your geography you have read something else, in your income tax you have read something else. You cannot do that. Okay, please remember, whatever your act says, whatever your specific act says, you need to follow always that. So, under your union territories, you have 5 different states: Andaman and Nicobar Island, Lakshadweep, Dadra Nagar Haveli, Andaman and Diu. then Ladakh, and finally Chandigarh. So whenever you see there is any, union territories are involved, means what? See, let's take again one example. Here is a seller, here is your buyer. Yes. Now here seller is from Ladakh, buyer is also from Ladakh. Okay, so here seller supplies goods or services. Okay, and here buyer will pay cash plus GST. But while paying GST, yes, you will see UGST plus CGST. Okay, because here when you see both the sides, Ladakh means transaction is same state transaction. So here you will charge UGST for that particular union territory, and half of the amount you will supply to your central government. Remember this point. Always when there is a same state or same union and territory transactions, you need to charge CGST on both the cases. Yes, only when you are crossing the boundaries, any state boundaries, whenever you are crossing, you are going to charge only and only IGST. Okay, so in case seller is also from Ladakh, buyer is also from Ladakh, means same state, no boundary, no crossing of that. Yes, so here you will charge UGST plus CGST. Now, one doubt might arise to you that what if here, suppose there is your Ladakh, yes, and here is your Chandigarh. Yes, now this both the places covered under union territories. Now here your seller from Ladakh and Chandigarh, there is buyers from that Chandigarh. Now here from Ladakh to Chandigarh, seller supplies goods or provides any services. Okay, so at the time of billing, buyer will pay cash plus CGST. Now, sorry, not CGST, a buyer will pay GST amount. Okay, buyer will pay GST amount. Now, what do you think? While paying GST by buyer, so which type of a tax he will pay? Which type of a tax that person will pay? Here you can see one is your Ladakh, one is your Chandigarh. Okay, both are union territories. But here your goods are crossing your state boundaries. The answer is yes. Okay, both the sides you don't have Ladakh or Chandigarh. Yes, both the sides you don't have the same state name, same union territories name. If this is not there, then means your state boundary is crossing. So you are going to charge, even on both the sides you have union territories, you are going to charge IGST. So this is very important point. Make sure you are watching this, this part specially again. Okay? Again, if you watch it, you might get the concept. This is quite difficult concept because, first is when to charge your CGST and SGST when there is the same state transactions like Maharashtra. Okay, whenever you are crossing state boundaries. Okay, whenever you are crossing state boundaries, whether you have union territories or other states, you are going to charge always IGST. Okay, remember this point. So this is about the 4 types of GSTs which are actually covered under your GST. Now, we have some threshold limit given under your GST. So let's start one by one. So here, if you talk about Manipur, Mizoram, Nagaland and Tripura, yes, and if you exclusively engaged in goods, your limit, yes, means if you touch this limit, if you touch 10 lakhs during your year, then you are going to get registration under GST. This threshold limit is for what? This threshold limit is for GST registration. Yes, GST number, please take GST number. Yes, so this threshold limit is for GST registration, that if you touch this 10 lakhs, if you are totally engaged in your goods, or if you're providing goods plus services, then also 10 lakhs. Yes, and which states are having this limit? Manipur, Mizoram, Nagaland, Tripura. M, N, T. Yes, like we have makemytrip.com, like that you can remember, because these places are very beautiful now. So if you are making your plan, if you want to see the seven sisters, then what you will use? Make my trip. So through that we have created MMNT, Manipur, Mizoram, Nagaland, Tripura. Then, if we talk about next states like Arunachal Pradesh, Meghalaya, Puducherry, Telangana, Uttarakhand, Sikkim. Yes, if you are following, if you are actually doing your business in this 6 states, totally engaged in goods, your limit is going to 20 lakhs. Yes, if goods plus services, 20 lakhs. Okay, means below this limit, if you're selling 19, 18, 17 lakhs during financial year, no requirement to take GST registration. If you're touching 20 lakhs, then for sure you need to take GST registration. So this is about next 6 states. Now, rest of states, if we talk about all other Indian states and union territories. Okay, your limit, if you are totally engaged in goods, if you're totally engaged in goods, your limit is going to be 40 lakhs. Remember, totally engaged in goods plus same state transaction. If you are doing business within same state plus you are selling only on only goods, your limit is going to be 40 lakhs. But if you are selling goods plus services, you are selling goods plus services, or if you are also doing interstate, means you are crossing state boundaries, that time your limit is going to be 20 lakhs. Okay, so this is about your GST threshold limit. Okay, so this is very important and you need to remember this point. Now, we have one GST council. Yes, like for advocates, they have their bar council. Yes, for state, we have state governments. For same, when we talk about GST, we have one GST department. Now, who are actually covered under this GST department and what they are doing? So here we are calling them GST Council, and now it is a governing body which includes Union Finance Minister, Ministry of State and State Finance Minister. Now they are responsible for what? They are responsible for main decision making, recommendations on issues like amount that to be charged, exempt from GST and GST rates. So here GST Council, who are covered under this governing body, Union Finance Minister, yes, then Ministry of States and State Finance Minister. They all will be the part of this GST Council. Now they are responsible for what? They are responsible for decision making and for making recommendations for what? For amount that to be charged under this GST, rates, yes, like you have 6%, 12%, yes or no? So which rate? Exempt goods that we have seen as cap. So who actually decides all these things? This GST Council. Okay, then finally we have this differentiation between direct tax and indirect taxes. So under this direct taxes, we have covered your income tax. Under indirect taxes, we have covered your GST. Okay. So if we talk about income tax, here you are going to cover incomes and profits. Now if you are talking about indirect, you are going to talk about goods and services. Yes, indirect taxes, here you can shift your burden. But when you are earning your salary, you cannot say my friend will pay this tax amount. You need to only pay directly to the government. So in case of income tax, you pay directly to the government. Here you cannot shift the burden to anyone. And in case of indirect taxes, we have intermediaries. Yes, and final burden is on your consumers. We all are, actually paying for GST. Then tax evasion chances are higher. Yes, under your income tax. Then in case of GST, you have less chances of tax evasion. And final difference, that is your direct taxes is a type of progressive tax. Higher you earn in your income, you need to pay higher taxes. Higher you earn your income, higher taxes you need to pay. But in case of regressive tax, whether you earn, whether you are not earning, even that small child when they are purchasing chocolates, snacks or anything, they are paying GST. Yes, so this indirect tax, GST is a kind of regressive tax. everyone needs to pay it, whether you earn, whether you are not earning. But under direct tax, if you are earning above that limit, yes, only that time you are going to pay direct taxes. So this is about GST. Let's solve few questions based on this. GST is levied on which of the following transactions? A, this is A, sale and transfer of goods and services, import of goods or services, lease of all goods and services. Under GST, we are covering all of the above. Correct answer is your answer D. Okay, then next. Which one of the following items are not in the GST regime? Alcoholic liquor for human consumption, banking services, insurance premium, transport services. So, not covered, that is your cap. Yes, that is the cap. So, correct answer is your alcoholic liquor for human consumptions. Then, which one of the following is why taxes have been replaced by GST? Sales tax, excise duty, service tax. Correct answer is all of the above.